So I'm Richard Sverrisson. I'm the editor-in-chief of Montel News, and I'll be your moderator today. We have on the front row here, as always, Montel journalists who will be asking questions, and will also be writing articles on what happens today, what is said by the speakers. We'll start off by looking at a question, really, which would have seemed preposterous 2 or 3 years ago, about German power falling below 100 euros a megawatt hour. Okay. Then we'll look at what has been a consequence of the energy crisis, is the boom in coal-fired generation. Then we'll look into more detail at what the impact of cuts in Russian gas flows means for the market.
Can you hear my voice? Is working?
And also taking a look at carbon, which suddenly seems to be moving in opposite directions from a lot of other energy commodities. Then we'll talk about LNG. And then also looking at the current drivers, looking at what's happening in France, what's happening with the drought, heat wave that we've seen, and the impact this will have for the winter. Then, after lunch, we take a look at the green transition, looking closely at the renewables and hydrogen, green hydrogen expansion in Germany, PPAs in Germany, how can you manage the current levels of risks and sign PPAs. Then looking at the view from industry, obviously a very, very serious state of affairs for Germany's industry and for Europe's heavy and also smaller industry at the moment. Then we will look more at what is the reaction from policymakers. They are obviously under extreme pressure at the moment to be seen to be doing something, both at the national and European level. I mean, these prices are very unsustainable for many households and businesses across the continent. So we'll have a discussion on current proposals and some reactions to those. I'd like to express a warm thank you to all our partners. So we have ABN AMRO Clearing, Axpo, Energy Weather, Circular, EPEX Spot, Nasdaq, E.ON Commodities, Phoenix, Nord Pool, GreenFact, Bright, and Climate Link Up. So thank you all. Without them, this would not be possible. But let me just sort of, before we proceed to the actual experts, I'd like to sort of say a few words about the current market situation. Oh, well, that's not the current market, so that's where we're going later this evening, but I'll come back to that later. Now, Energy Markets 2022, we are in uncharted territory. I mean, I've been in this market, I mean, maybe some of you in this room have been in this market for longer, but I've never seen anything like what we're experiencing at the moment. So I think it's fairly safe to say there are dark clouds, strong seas, and a lot of choppy waters ahead. So we're in, an unprecedented situation. It's a perfect storm. You have the gas cuts from Russia, cuts in flows. You have French nuclear availability at an all-time low. The reservoir levels in the Nordic region are also at historically low levels with a very increasingly dry outlook. You have the drought, the heat wave that has both reduced water levels across Europe as well as warmed them up more so they can't be used for cooling purposes as they were before. You have companies, some not so very far from here, being nationalized, and prices at unbelievable levels. But so this conference will hope to address the problems and challenges ahead. Does the future, do the coming months look a bit like this? But I hope the speakers will also maybe, in the way that we have to navigate the months ahead, we'll also focus on some of the safe havens, and there are maybe some rays of light out there. And I think we're in Düsseldorf, we're in Germany, and Germany is key. If you know, if Germany fails to steer through these choppy waters, the rest of Europe will certainly also fail. We have gathered several experts here today, and I think that's enough from me. You've not come here to listen to me, you come here to listen to the people who actually have some proper opinions on these matters. So I think, without further ado, I'd like to ask our first speaker to come to the podium. So that's Tim Steinert of Ennovis. So please, the floor is all yours, Tim. We're very keen to hear what you're going to say about these price levels. You know, is 100 euros a megawatt hour a dreamland, or can we actually get back to those kind of levels?
Good morning, everyone. First of all, thank you for inviting me and having me here today. As Richard put it already, uncharted territory. I think this described it quite well. I'm working in mid to long-term power price modeling, forecasting. And if you would have asked me, I would say 15 months ago, what would I think where the German power price could get in a 5% percentile, I would have said something maybe like 180, 200 euros per megawatt hour, and every week a new. We saw prices that we never dreamt of could ever occur in European energy markets, in the German market especially. So I'm talking today about when could German power drop below 100 euros per megawatt hour. The title was chosen in July, so maybe today it would be like 200 euros or 250 euros, I don't know. But let's start with just to refresh your mind what was happening in the last 12 months on the German power markets. Here you see a chart of the calendar year 23 futures markets, German power baseload over the last 12 months, and what we saw happening is so impressive. And if you look at the chart, it is just astonishing to see what was happening to German power in the 12th last month. So if you remember, maybe August 2021, we were already in a situation with elevated price levels due to gas prices higher than usual, due to increasing demand, especially in Asia for LNG, which also affected the German gas prices. So we were already in a situation with elevated price levels. And what was then happening also in the wake of the invasion, Russian invasion in Ukraine, is something that you can barely see on the chart. So when you look at late February 2022, you see something, the line is moving pretty quickly, high volatility, and we already saw price levels increasing from day to day by 30 to 40%. Yeah? But what was then happening in late August was even more astonishing. We saw trades for German power 2023 of almost 1,000 euros per megawatt hour. And I think it's fair to say that nobody in this room or no one that I know would have expected this to happen. A second point that second thing that I want to point out here is what we're seeing right now on future markets is no longer explainable by fundamentals alone. Yeah, so what you see in the grayish line is the variable cost of generation for a modern CCGT power plant. So you see that there's a strong correlation over the whole chart, but since May 2022, we see high markups in or premiums in the German power 2023 compared to variable cost. So gas prices alone are not able to describe what is happening in these markets at the moment. Yeah, and from our perspective, there are four main drivers describing the situation right now that is happening on these markets. So the first driver, you know all about it, right? So gas prices increased more than sevenfold. Secondly, we have a very, very low availability of nuclear power generation in France. So power prices in France are even higher compared to the German prices right now. We already saw prices above 1,200 euros per megawatt hour for future 2023 in France. So this adds also to the perfect storm, as well as the drought in Europe we saw, and we'll be seeing quite more often, I guess, in the following years. So minus 25% of hydro generation in Central Western Europe and Iberian markets so far compared to last year. And a fourth driver, which is, a bit underestimated, I think, or which is not discussed so much also in the media, is liquidity of futures and forwards markets. So what you see here on this chart is the trading volumes for German power. This is only OTC trading volumes and all kinds of contracts. But we see a decrease by 60% in trading volumes over the last 2 years, which are, I would say, the reason why we cannot no longer explain what is happening in future markets compared to the pure fundamentals, the underlying fundamentals. And when we talk to our clients, even off-taker side or also generators, we are hearing more and more that they're having big problems also buying or selling their tranches in the futures market so far. So what is our outlook for the future, to answer the question of this presentation? So when is German spot prices to drop below 100 euros again anytime soon? And I would, so our modeling suggests that this would happen in the late 2020s again, yeah? And this is driven by mostly gas price development. So what makes us believe in this, what I'm showing you here today, is the belief in an ease in the gas prices medium to long term. So LNG and substitutes for Russian gas, and the expectation that long-term gas prices in Europe have to be connected at least to the full cost of LNG imports into the German market and Europe as a whole. Yeah, so. This projection is then mostly based on the gas price, the underlying gas price forecast of this modeling. So what we also see until the late 2020s, that we have a high correlation between German power prices and gas prices. Yeah, so German power increases by €1.20 per megawatt hour when gas prices increase by €1 per megawatt hour. And this correlation we still see until the late 2020s. Only after 2030 onwards, with even more installation of renewables and decreasing share of gas-based generation, we will see a loosening of this correlation, and that German power and European power as a whole is no longer connected or so much connected to long-term gas price expectations. So last but not least, and I think there will be a bigger discussion today also on a panel about the German cap price of 100 euros per megawatt hour. I'm sorry? Was there a question? No. Okay. So last but not least, also to put this in perspective with the German power price cap, we don't know yet, maybe 100 euros per megawatt hour. I wanted to show you this analysis also based on the scenario that I showed you. So if this is really possible, and we don't know yet, yeah, how the government wants to pull this off, to skim off these excess revenues above 100 euros, 180 euros per megawatt hour. This could mean that in 2023 there would be around 32 billion euros that could be redistributed to end consumers in Germany. Yeah. And this is the underlying assumption is that the price is at 180 euros per megawatt hour, and that renewables, coal and lignite and nuclear will be affected by this. How they will pull it off, because we all know that this excess revenue might not be laying with the installation itself. There might be an off-taker who is benefiting from this. So how will the government try to get the money from the off-taker, and will it? So we don't know yet. So these 32 billion is the upper bound of what we can think of could be distributed to end consumers in Germany. And this could mean that end consumer prices could be eased by around 7 cents per kilowatt hour compared to the power consumption that still has to pay or had to pay the EEG level in Germany so far. Yeah, so this was it from my side. I hope this was a good introduction to you. I think we will cover more of the topics that I mentioned in more details in the upcoming presentations. And yeah, if you have questions, I would be happy to answer them.
Thank you very much. Hello. Thank you very much, Tim. Thank you very much. That was a very excellent overview of the current situation and what we can expect to come. Tim, my first question, you said that the power price will be very much linked to what happens with gas. But isn't there a firm wish, if you like, very strong wish at the European level, and especially in some member states, to decouple power from gas? I mean, how do you see that working?
Yeah, so we are discussing a lot about this at the moment. And I don't think that there is a way to decouple power prices from gas prices. So what you have to focus on is to ease gas prices, and from my perspective, not by regulation, yeah, but by bringing demand down and bringing subsidies to the market for Russian gas. I understand that this takes time, and that there is a whole chunk of this so-called excess revenue that politics want to redistribute to end consumers, and I personally can understand it to a certain extent. Yeah, so I think by an excess revenue tax, for example, this would be a reasonable measure to do so. But intervening in markets itself and messing with the price signal and also the signal for scarcity of gas and now also power, I would say this is not a great idea, and I hope policymakers will understand this.
Absolutely. I mean, this is always the case, isn't it? Some of the emergency measures either become more long-term than initially intended, and they have the unintended consequences. You know, what would this kind of signal to investors who want to invest in German renewables if they think that, okay, the prices go over a certain level, then the government takes my profits? What kind of indication does that give?
Not a good one. So there is very, very high uncertainty in the market right now, and if we talk to our clients from the off-taker side, this is of course a really big issue, because they have to shield themselves from this power price cap, and they have not a clear idea at the moment how to do it, because it's still not clear how this mechanism will work or not work at all. Yeah, we just don't know yet, and this really distorts the market, the PPA market at the moment. As well as some installations that would have gone online this year or maybe last year. So they are also struggling with this. But I would say so. Also showing this graph, I mean, this is just, if this gets implemented, this would be just a very temporarily thing, yeah, until 2025. So most of the projects under PPAs that will go online will only come from late 2024, 2025 online, yeah. So the market is not dead, and it's not like everybody is not doing anything right now, but the uncertainty is high, and it just it's a mess. It's a real mess.
Absolutely. You very clearly put the link between gas and power. That's the fundamental driver will be gas. So, but Europe will be competing with Asia for this gas. So what will be the main drivers in Germany? Will there be like an outage in Japan or a cold snap in China? Will these be the things that people in Germany will need to look at to determine the direction of German power?
Not solidly, but of course this adds also to the equation, and yeah, of course. So global LNG is something that has a high impact and is increasing impact in the European market. So of course this is also something that we have to look at. But yeah, I'm just very curious about the upcoming winter and also the supply issues, not only from the gas side but also from the capacity side. So yeah, let's hope for the best.
Yeah, absolutely. It's going to be quite a nervous winter. Any questions from the audience? Yes, Paulo Cohi from Acusmatics.
Hi, good morning. Thank you for your presentation. A quick question on the 4 drivers you had in a previous slide, specifically on the OTC decreasing liquidity. Can you tell me more about the sources of these and what do you think it's going to take for the liquidity to increase?
You mean the reason for it? Why it's going down?
Yes.
Yeah, I mean, you all heard it in the news. Also, it's one main driver is the increase in margin and margin calls that are related to futures and forwards trading. So with increasing prices, you need more liquidity. And also, when it comes to open position that you have in your books and high volatility, there is an increasing risk for also short-term liquidity for traders and partly also off-takers. So this is what I would say is one of the main reasons. But we have more traders in the audience today, so maybe I'm also eager to hear more about these reasons from the trading perspective, since I'm always looking at the midterm and long-term perspective. But what is clear that it is a real problem that bid-ask spreads are just increasing and very, very huge, and yeah, that this is a problem if we don't have liquid future markets. This is also a risk for investments into new projects. Definitely.
Excellent. Any other questions? Yeah, over here. Please state your name and company. Thank you.
Hello, Jérôme Lepage from EFET, the European Federation of Energy Traders. I'm quite interested to understand how you came about with this 32 billion saving for German power with a clawback at 180. We're hearing lots of different numbers, like 140 billion throughout Europe, just stated by President of the Commission, van der Leyen. So yeah, understanding better how you calculated that would be pretty nice. Thank you.
Yeah, sure. So the 140 billion, I think, was for not only power but also gas, oil, and coal. So I think on the European level it was 170 billion, and we don't know for which year. I guess it's for 2022, but no one knows because it's not in the paper. So how we calculated it, we took our model for mid to long-term power market outlook of Germany, and Europe as a whole. And what we looked at is the German generation, the hourly generation from the model, multiplied by the hourly prices from the model. So this is the total volume, yeah, for the technologies under this price cap. And then we cut off at 100 euros per megawatt hour, yeah, and differentiated. Okay, how much of this volume is above 100 euros per megawatt hour? So generation times 100 euros or above, and what is below? Yeah, and this is then the total volume and the share of the clawback that we could think of. Yeah, and once again, this is really the upper bound that we can think of, because we don't know how they will reach out for this money, and we already know from the European Union that the real revenues, also from the real revenue situation from futures trading, from PPAs and fixed prices and whatsoever, should be incorporated in this 100 euro tax, and this is spot price alone. Yeah, so this is the total profit margin that does not have to be with the installation itself, but it might be with the off-taker or someone who has a fixed price with the installation. So this is really the upper bound.
Okay, Tim, I think we're going to have to stop you there. So thank you once again, and here's a little present from us.
Thank you. That's very nice.
Thank you very much, Tim. Thank you. Yeah, please. Yeah, thank you. Our next subject is coal. I'm sure most of you noticed we're experiencing a bit of a coal boom in Europe. Or return to coal-fired generation. It's also quite interesting in Düsseldorf, by the Rhine, noticing many barges flowing south, full of coal, and some were even flowing north. So I think we have an expert on all things coal, and she will talk to us about hopefully say where this coal is heading, and much more. So it's a great pleasure to welcome you to the podium, Diana Battila of Alpiq.
Thank you also for the invitation to be at this conference and for this exciting title. The title that you have chosen for me today has been, is this coal boom only temporary, or are we going to see coal staying with us forever in Europe? So for today, I have decided to focus on several points for you. First of all, I will start with the global coal price overview. What has happened in 2022? What are the main supply and demand drivers? What is going on in China, as always? How much coal are we still burning? What is happening with gas? How much coal should we burn in the future? And especially after the embargo that we have placed on Russian coal, where is this going to come from? But first of all, let's focus on the prices. And as you can see on this chart here, we have experienced a record strong growth in coal prices throughout the world, both in Europe, the API2, and in the Pacific, in Newcastle. And you can see on this chart that actually everything started before the war. So at the end of 2021, we were already into a pretty strong environment, the reason being connected with a lot of supply disruptions. What is that, or where has that been coming from? Well, if you look on this chart, you can see the total exports aggregated from major suppliers in the world, and also when La Nina has happened in the history. La Nina is the weather phenomenon that brings a lot of supply disruptions because it changes precipitation in the global market, bringing more rains to Australia, Indonesia, Colombia, South Africa. But on top of that, it brings colder weather in Northeast Asia especially. So that's the perfect mix for a tightening market for the fuels. 2022 started pretty bad. Why? We had a ban on Indonesian coal. The market in Indonesia tightened. So the electricity market did not have enough coal supply. As a result, the government intervened, banning exports of Indonesian coal. If you look at this development in supply, you can actually, the red line in the chart, you can actually see a very similar situation with 2016, when another La Nina episode happened as well. And for the rest of the year, our expectation is that supply is not really going to come back strongly. The reason is, as I mentioned, the risk of rainfall in Australia, the fact that we do not have enough new mines in the market, the fact that capital is constrained when it comes to investments. Personnel is not there. People have moved away. They are moving to other sectors at the moment. And the fact that everyone, let's say, is not going to put money into a coal mine for several years due to the energy transition. Apart from the rainfall, we also had some issues in South Africa with rail performance. Colombia, there are many protests happening because of salaries. So all in all, everything has been constrained. US, I want to mention this, usually was, let's say, the swing supplier in the market, always coming to rescue the world. This year is not there. As I mentioned, there is not enough supply. When it comes to the prices as well, what has happened after the war has been a pretty strong disconnect between different qualities. So the high energy calorific value coal has been increasing strongly because everyone wants that, but the low calorific value coal has not followed the same pattern. As well, Russian coal now, that is not coming to Europe, is heavily discounted. The price at the moment is around $150 to $200 per ton, while as we can see, the API2 is at 300 and Newcastle actually close to 400. So who is buying that? We will see later on that there are still friends of Russia, let's say, when it comes to the coal market. Another thing that has happened is the coking coal market. Coking coal is used for the production of steel, mainly in China. So if we do not have growth for the coking coal, we could actually sell it as thermal. At the moment, because of this weakness in China, and as we know, the economy is not doing pretty well. We know there are property issues, real estate issues in terms of property investment. As a result, China has not really been present now, and this coking coal that I mentioned can be sold into the thermal market, and this has helped a little bit. But going forward, we still need thermal, and actually the supply is not really there to meet demand. I mentioned China has been pretty weak. And if you see on this chart, China mainly rely on its domestic production for coal. This year, China, or the Chinese government, has pushed strongly the production of coal into the market because the government does not like to be reliant on imports. As a result, imports of coal in China have been weaker. But this is also coming from the fact that power generation was not that strong so far this year, but jumped strongly this summer. It was a heat wave, hydropower generation was very low. Usually during the summer is the peak season for hydro in China. This summer it was pretty bad. As a result, China needed more coal. But one interesting thing is to remember that China is not a free market, like not a liberalized power market. They have fixed power tariffs. So as a result, the government tries to control the coal prices as well that are actually sold to power generators. So as a result, you have this mismatch between high demand for coal, but then the government comes and says, no, you're not able to sell it at a higher price because power plants will make losses. So this is what happens in China, and the government is always focused on controlling the market on both sides, power and coal. But let's get back to Europe, and if you see on this chart, we are consuming a lot of coal. Of course, the main countries are Germany and Italy. And so far this year, we have consumed pretty high volumes, around 40% higher than in 2021. And the interesting side was that Germany came with some regulations in order to store coal. So basically, power plants are supposed to have 30 days worth of generation or 60 days in November and February for the next 2 winters. If you remember back the prices that we have seen, actually this tells us that there is constant restocking happening in Germany. The problem was, of course, the Rhine. And the Rhine level being so low constrained deliveries from the ports, so the ARA or the Netherlands ports in Europe to the power plants in Germany. As a result, at the moment, we have huge stockpiles there. Also, the government was saying that this coal should be stored very close to the plant, or it has to go in order to reach the plant in 10 days. This tells us clearly that if we have high consumption, and if there is this security of supply in place in Germany, there will definitely be continuous import demand, because we need the coal there to have it ready, let's say, by the plant. Another regulation that has been released was related with the prioritization of railings, as you know. This has also been applied. So basically the government in Germany tries to do as much as possible to keep things in place. We have discussed before about short-term marginal costs and power prices. And what you can see from this chart, based from delivery to the future, there is a huge, huge change in terms of these costs, and especially in the difference between the short-term marginal cost for coal, which is the yellow line covered by the fuel oil, and the gas. What I just mentioned before means that actually coal and fuel oil are currently at the same cost in German power, while gas, you see the red one, is so much higher. The interesting part, as we have heard before, is actually the difference between the power prices in both base and peak hours versus the cost of gas. And this difference is attached with the high risk premium that the market is placing in at the moment in order to account for the risk of nuclear unavailability in France, the fact that we have so low hydropower generation at the moment, or hydro stocks in the system, and why not even the uncertainty about getting the gas. And even the Rhine level, maybe even getting the coal. So based on the market prices at the moment, we see that especially in the next 2 winters, the market is pretty tight, or expected to be pretty tight in Europe, while further out, a bit of a loosening is expected. If we are to look at another way, or let's say the coal to gas switching, we used to talk about this a lot in the past. Used coal to gas switching, what should be the level of the coal price or the gas price to induce the substitution? As we see before, that's not going to happen very soon. But just to be curious about it, as we see the API to curve around 300 down, if we look at gas and we take the THE market in euro per megawatt hour, we take into account the carbon, the gas market tells us now that in order for gas to be at the same level with coal prices could go up to $1,000 per ton. If we look at this from the other point, like from the gas market term, and we have the THE at the moment at around 200 euros per megawatt hour, and we say, where should gas go in order to be at a similar cost with coal? Well, it should go to 70. That's also not going to happen very soon, but still these are the, let's say, the signals that we see at the market, and also signifying or signaling to us how tight the gas balance is. What's going to happen in the future? And based on the model, if we choose these 5 countries in Europe, this is the installed coal power generation that we are expecting in the future. We do see an exit in 2030 in Germany, so this is why in terms of the consumption, we expect that from 2025 onwards, coal consumption in Europe will start to decrease, given that, let's say, nothing else surprising happens. And as you can see, the next 2 winters will be pretty strong, very similar to 2018, 2019, which means that in terms of coal consumption, we will need at least 5 to 6 million tons a month from these main 5 countries, and after 2025, it will start dropping to maybe 2 to 3. If we add Poland on top of that, a very important consumer, and now they were a little bit even more courageous than Europe. They said, no, we are going to ban Russian coal from June, boom. And now they are like, we are not finding coal. Yes, you're not. So if we add Poland to that, it's going to be up to 1 million ton extra. And Poland also has a lot of domestic production of coal, actually the last one standing in Europe. This production is not increasing either. So as I said, the exit expected in 2030 and consumption to ease from 2025 onwards. But where are we getting it from? And we were very happy to rely, or let's say, to increase our dependency on Russian coal. We had a very diversified basket before. We were not happy with that. So we started, okay, we are going to buy more Russian coal and get rid of the rest. At the moment, we have to go back to our friends from the US, South Africa, Colombia, even Australia, and pay the price to get it. What is Russia doing? Well, Russia continues happily selling to China, India, Turkey, whoever wants to buy it. Japan, South Korea they have not yet made up their mind whether they want to or not. But for the moment, they still get it as well. So when it comes to the future and thinking about where is the marginal ton coming from, as you saw in the first chart, it's coming from Australia. That's the highest price supply in the market at the moment. So that means that for us in the future, it will be very important to keep the arbitrage open for Australian coal into Europe, which means we are going to compete not just for gas or the spot LNG with the Asians, but also for coal when it comes to the future. And for this winter, it's very important to look, of course, to see what's happening with the policy intervention, to see what's going to happen with the demand destruction. Are we going to really make it or not? That's the most important thing. How is the weather going to play out? How much coal and gas, especially LNG, will Asia buy? Is Asia going to fight with Europe? Because at the moment, if we are looking at the gas market and the gas prices, Europe should be the market absorbing all the spot LNG cargoes. Will Asia jump to step in to take part of that? We have to see. On top of this, gas balances will, as I mentioned, depend a lot on the LNG imports that we are getting, as I said. But on top of that, the infrastructure and capacity for the LNG regasification will be extremely important. And that will be a major driver for coal as well, as fast, let's say, as we are going to add this regasification capacity. 2025 is currently the year expected to have more LNG regasification capacity that could save us as well. But for that, we will still compete to get the supply. As I mentioned for coal, we will have to continue replacing these tonnages from Russia with something else at a higher price, while China, India, Turkey, and all other economies will continue getting the Russian coal. And when it comes to our coal plants, we will still keep them as long as we need, up to 2030, based on our expectations so far. And if we make a summary of all these drivers, we understand that power traders will probably need more than 6 screens to actually be able to take a look of the market compared to now. Thank you very much.
Perfect, Anna. Thank you very much. Thank you for an excellent overview, as ever, Anna.
Welcome.
I'd like to start off. You mentioned La Niña. What will it mean for supply from, for example, Australia, Indonesia, but also on the flip side, from demand from China and other Asian countries?
So basically, the future looks like that. China and India will compete to produce more coal domestically. So their reliance from the imports market more likely can decline. Mm-hmm. And also they will rely on these Russian volumes that no one wants at the moment, or they just say they don't want for now. We don't know how the future will look like. But when it comes to the import market, getting more from Australia, from South Africa, implies that there will be demand destruction somewhere else, or we are forcing other buyers to switch to a different quality, meaning either a lower calorific value coal, or even making them change their power markets to switch to renewables, even to start building more.
Absolutely. Another question relating to the coal stocks now are quite well replenished in Europe. Where, as we come into winter, how hard will it be to fill them up without having the Russian coal there? I mean, it all comes down to price from maybe, Australia and South Africa, as you mentioned.
Yes.
Yeah.
From the price perspective, let's say if we are having any kind of supply disruptions in Colombia, floodings again, in the US, something happening with the rail, in South Africa, the marginal ton, as I mentioned, will come from Australia, meaning that Australian coal plus freight will actually be the marginal tone to set up prices in Europe as well in the longer term. But how we are going to fill up the stocks, that's the very interesting topic. We are going to pay for it. But the thing is, we do not know what the stock level is at power plants in Europe. I'm not sure if you're aware of this. This information is not publicly available because no one wants to share it with us. So at the moment, I would say we are not that bad, given that we were so eager to restock at high prices, very smart as well. And now we actually got all these stocks or volumes stuck at ports. So as the wine level is expected to improve, which should happen starting from, let's say, October onwards, and we are getting it more on the rail, we are kind of open up this logistical channel, so removing the constraints and getting the coal to the power plants. This is one thing, like we are gonna get these volumes, we are gonna force other buyers in the market to switch to something else, and as I said, we are going to pay for it.
Absolutely. Any questions for Diana? Yeah, Nathan first, and then yeah.
Thanks, Diana. I understand that a lot of Russian coal is effectively stranded because it was linked to markets in Europe. I understand they, of course, want to be able to export more to countries like China and India. How much potential do you see in the next 2-3 years, I suppose, for Russia to reorient supplies to Asia to relieve the global system, and how much is really kind of permanently out of the market now and a permanent supply constraint?
You mean solely on Russian coal? So first of all,
yeah.
The way Russian coal is placed, so it's produced in the middle of Russia, so you have two options, to either sell it on the rail to the east or to the west. To the west to Europe, you can put it on a ship from northern, from Murmansk ports, or from the Baltic Sea to ship it to Turkey directly, so that's open. Given the fact, or to the Far East directly on a ship to India, China, given the fact the prices are discounted, even though the freight cost is longer and more costly, it's actually making sense at the moment. Because you get the discount from the price and, okay, you pay more for the freight cost, but the problem would be insurance. That was actually discussed in the market lately, that most of the insurance in the coal market is actually done by European companies. So these buyers are not able to buy it, even if they want to, from Russia, because no one wants to insure those cargoes. So in terms of the volumes, you can actually take it, of course, not at the low prices as before in terms of, I mean, as the ones to Europe, you will have to pay more, but the market will remain tighter for longer. So then this extra cost will cover for the, let's say, the total trouble of getting it into India or the Chinese. So you have the options. I don't think Russia will invest in infrastructure capacity, meaning railways, to send more coal to the rest of the market. I think they have bigger problems now and other things to focus on, but the way it is there. You just have to find an insurer that would be willing to do it.
And the next question here from Vera Eckert from Reuters.
Hello. I have two questions that aren't related to each other. The first would be, do you have any insights into the reactivation of idle coal plants in Germany and the speed of that this winter? Asking from the perspective of the power market. And the reason I'm asking is because STEAG and others have been raising problems there to comply with government requirements for 30-day storage that you referred to and other things. And the other thing is you mentioned coking coal being used for thermal, and it's the first time I heard about that, so forgive the ignorance. How does that even work?
Mm-hmm. So for the first one, the installed coal power capacity in Germany is currently around 19 gigawatt. Out of that, you have like 14, 15 into the market running, and 3.74 gigawatt is in reserve. This reserved capacity will be available actually until December, so you can have this max, let's say potential close to the max installed capacity in Germany running in this winter and even next winter, I'm sure about it. And when it comes to the storages, if you take this 19 gigawatt, you assume a utilization of 80%, which is, let's say, close to the highest possible. For 30 days, you will need 4 million tons of coal. For 60 days, you will need 8. If you saw on the stocks, we already have 8 at the ports. So if we assume that Germany has already bought them, or Germany has them, who knows who has them, we could say that we are not that bad in terms of this, but of course this will be consumed, so you will have to continue buying it, importing it from the international market. The second one, with the coking sold as thermal, coking coal has a higher content than thermal coal, so you can not wash it, let's say, properly, to put it in an easier way, and then you can sell it as thermal. But you cannot take thermal to sell it as coking, because you cannot increase the calorific content, but you can decrease it if you want.
Excellent, Diana. I think in the interest of time, we shall move on. But fantastic overview, Diana. Thank you.
Thank you
and
very
a
much.
small present from us.
Thank you. I will take the other stair.
Okay, yeah, it's probably better.
It's better. It's a bad idea here. Thank you very much, everyone.
Thank you. From coal to gas, our next speaker will talk about the impact of the cuts of Russian flows. So it's a great pleasure to welcome Brian to the stage. Wayne Bryan of Refinitiv, or London Stock Exchange Group. So Wayne, a warm welcome to you, please. The floor is yours.
Right, good afternoon, or good morning, actually, everybody. And again, thanks for inviting me here again, Richard. It's always a pleasure to speak for you guys. And I think, the last time I actually spoke for you guys was 2019. And it was talking about coal and German gas-fired generation, etc. So now I'm back here again, and the market's changed quite a bit since I last spoke here. So now, firstly, I think it's worth taking a look back. Now, the last time I was here, I posted this slide at the end where I was looking at 2019 and beyond, what's going to be happening. Of course, he's played a big part in this. She's no longer here, and the less said about that man, the better. LNG is still obviously helping with everything. Carbon, we don't really need to worry about that too much in terms of gas at the moment. Renewables still playing a big part, and of course, you've got China. So I thought I'd take just a small look back in terms of how things have changed. And just quickly, just for those, what might not be good reading, but this is where gas prices were back in 2019. As you can see, the highest price we had there was Italy at 18 euros a megawatt hour. Now, in these times here, I was actually working as a gas and power trader, and I remember at the time thinking, oh, these prices have spiked a little bit, but now they're quite comfortable. So it's quite funny to look back at this now, and even when I was putting this presentation together, I was really thinking, wow, this is cheap. And just for those in the power market, this will probably make you even more sick at. And when I used to trade power, 50 euros was quite expensive. And here we are. The highest price again is Italy, of course, 64 euros. And as you can see, the German, which would have been, yes, Cal 20, 49 euros. So as we can see, things were very cheap then, and things obviously have changed quite a lot now. So anyway, enough of the look back. Let's now take a look forward. Oh, one last slide, actually. This made me laugh because people were asking me about Nord Stream, and some of these comments were quite good, actually. Donald Trump especially, geopolitical weapon. That's probably one of the only things he got right. He kept saying that Russia would weaponize gas. They did. I like this guy here, the Danish Prime Minister, Lars Løkke. He's no longer in charge, of course, but he said he'll do whatever he can to delay the project, even if he cannot prevent it. So I'm sure he's a happy man at the moment. And of course, the Americans said it's a high sanction risk. And lastly, the European Commission for Budget and Human Resources, he said it's unstoppable, and it's already complete. So as we know, that Nord Stream 2 is looking dead in the water at the moment. So yeah, things were a lot different 3 years ago. I'll take a look first at some of the prices, and I'll quite wary of time here, actually, because you guys have trimmed the presentations, savings of energy. So here we go. Firstly, it's been quite a 12 months, and ignore the busyness of this slide, but I thought I'll highlight some of the key points. We all know where the prices have been going and what they've been doing, but I'll just talk about, 12 months ago, again, we were here, 40, 50 euros a megawatt hour. Storage and then geopolitical concerns started to ramp up. We had the issues, the build-up of Russian troops, and then them saying they weren't going to invade Ukraine. Not many people believed it. Storage concerns started to ramp up. Then, of course, we get through the winter here, I should say. LNG was obviously came to the rescue here. And then, of course, the war happened, or the Russian invasion, sorry, of Ukraine happened, and then we saw the first real big spike in prices. And that also killed any hopes of Nord Stream 2 starting up. Then we had a lot more of these, say, what shall I say, Russian sideshows, and if we started with the ruble payment saga, we all remember that, with a lot of companies not paying in rubles, getting their gas cut. And then we at Refinitiv at the time were saying there's a good chance that we're going to see quite a halt in quite a lot of these flows. Fast forward a little bit, then we had the turbine saga. It reached obviously a climatic but predictable end with the full suspension of flows via Nord Stream 1. And then the recent market, and these are yesterday's closing prices, we've seen a little bit of softness. Demand actually, the last couple of days actually, it was quite strong, actually even above last year. But we saw a soft demand. Storages are refilling, and the potential for policy interventions, price caps, etc., really had an impact on the prices. And now we're kind of trading range bound. But one thing, lastly, I'll just draw attention to is the spread. As we can see, this spread historically always favors injecting in the summer, etc. And since the start of the Russian invasion, you can see that spread has peaked, I think, around 18. And it's still at around 10 euros, which highlights the risk ahead. Just a quick one, looking at just some of the volatility. We saw volatility we've never seen before, and also volumes. But interestingly, now volumes have started to fall as we sort of lost some players in the market. Looking at volatility, and again, if you look back, the last time we had a real sense of, this is the day-to-day close, TTF, would have been in 2018 when we had quite a lot of problems in the market. Ever since then, as you can see, no real volatility. And then as we see now, with even 50, 60 euro megawatt hour moves on a daily basis, and this is where I'm glad I'm no longer a trader, to be honest. And one thing as well is falling is liquidity. Liquidity's falling. Margin calls are playing a big part, and recently Equinor, they stated that companies in Europe, excluding the UK, will need around 1.5 trillion euros to cover the cost of exposure to the current gas market. Now, if you think of the US subprime mortgage meltdown, that was at around $1.3 trillion, so it kind of highlights what we're facing at the moment. Supply and demand, actually we're in the middle of Refinitiv now, and the European gas team have putting together our European balance. Now typically we'd have actually published that last week, but due to the ever changes in the market, we're going to publish it at the end of next week. So I haven't got all of our supply demand figures, but I've got a good selection here. In terms of what's happened this year, Northwest Europe has managed to substitute Russian supply this year. What next? And that is the problem. And you can see from gas year 20 to gas year 21, LNG has obviously had a big impact. UK gas production, actually the UK has been a proper net exporter to Europe over this year due to its soaking up excess LNG capacity. But of course, the big story is the Russian volumes, and we've seen a big shrinking in them. But what we're going to do next year is, or this winter is obviously going to be the problem. And now looking at our early look at next winter, or winter 22, it's going to be highly implausible to be able to substitute all of these lost volumes. And as you can see, what are so far our forecasts, we're seeing the big drop in Russia from 43 to 7 BCM. Norway's pretty flat. And then we see LNG again is coming to the rescue. And our LNG research team have given us assurances that we're going to see quite a lot of LNG over the coming months, but of course it's dependent on price and what's going on in the Atlantic and Pacific basins. And again, mentioning LNG, you can see here we've seen unprecedented surge in cargo arrivals. As you can see, up by 77% year on year, or 23 BCM. And you can see, and here, obviously, we focus on Northwest Europe here in Refinitiv Gas Team, and you can see here the ramp-up of deliveries. I mean, it's quite stark, really, and it's really helped get us out of this sticky situation. LNG capacity is rising, but as you can see here, this is looking at the forecast and also the send-out range, potentially, if we get enough LNG. And that's the point, the capacity is increasing. We've got a lot of these FSRUs, as you can see, that are coming online over the coming months and years. And this obviously is going to help the situation, especially in places like Germany. But what we're seeing now is a lot of countries are making these contingency plans, and the FSRUs now, as we can see, we're going to have quite a lot more coming online. So this is also going to help alleviate the loss of Russian gas. But again, TTF remains at a premium to the Asian market. However, winter 20 should serve as a reminder that things can change. And if we remember winter 20, there's the Asian price there. It spiked massively on weather. And that, again, is a big concern for us. But as you can see now, we're still trading sufficiently above. And of course, Chinese demand is playing its part. There's still quite a lot of suppressed demand from China, and also India, Pakistan have been sidelined by these high prices, which has helped Northwest Europe soak up the excess volumes. Looking at demand, I mentioned that heating demand is normally is going to play its part this winter, and again, it's normally non-elastic to price, but will it change this year? September, as you can see, these numbers might give us some indication, but again, I was looking at the numbers from the last few days when we saw a little bit of below normal conditions, and we saw demand above last year's levels over the past few days, so I'm not too sure. However, the EU measures and record levels, of inflation, even in the UK, I'm reading, watching the news, and people are saying they can't afford to heat their homes, they're not going to be using cookers this winter, all of these things, so we may see a reduction across Europe as a result, mainly due to the prices, to be honest. Taking a look at, we look here at 20 weather scenarios from 2001 to 2020 when we're forming our forecast, and you can see here the difference between the coldest and warmest scenarios, about 300 terawatt hours. That equates to 55% of Northwest Europe storage capacity, or Northwest European storage capacity. Now, again, that shows that the perils that we're facing, again, dependent on the weather. Non-LDZ gas demand as well is also at record lows. You can see this line here in gas year 21. Some of that is to do with, obviously, a lot of these big producers have stepped out of the market due to the high price, and you can see it sort of accelerate at the start of the year and into this year. So this, again, is something to look at, even though gas for power demand remains strong across Europe, but coal has actually helped substitute quite a lot as well. And if you look at the forward curves, there's no real likelihood of any coal to gas switching over the coming, perhaps the next 2 years, barring a complete collapse in gas prices, which doesn't seem quite likely at the moment. Some of these demand reductions, what we're talking about, can have a positive impact and avert supply shortages. This is looking at weather years for Germany, and if you see that most of these shortages will appear in Q1, and again, if you look at a 4% demand reduction, you see the shortages start to struggle. 7%, and we're in a much better place. So we can really help with these demand reductions, but again, we need to see it in practice. Wind generation, again, will be important this year, especially when it comes to German gas burn as well. And if you look at when you've got the maximum wind and then you've got the lowest gas, you can see the differences here. And so what we think this year is this wind generation, or the wind renewable output, is going to have a big impact on the German gas burn. And of course, we could apply this to several markets as well. Storages, we're ahead of our targets, and again, will it be enough? You can see now we're at 86.2 at the moment, and that's only been bettered by these two very mild years where supply was abundant and we filled the storages without any concerns. But again, weather will play its big part this year. Moving on to the weather, and this is not my own research, I did use our weather analyst, George Muller, who's actually a very good meteorologist, and he provided me with a couple of information that basically what he's saying here, if you look at the sea ice, the real chance of now is cooler spells at the later part of winter. So we're talking the start of 2023 onwards. We could see a real cold snap. And that's also confirmed by the La Nina. And as you can see, late winter season, increased likelihood of blocking weather scenarios. And if we see these blocking scenarios, we could see a real increase or decrease in temperatures and increase in consumption, which will really play its part in these markets. So something to keep an eye out for. And his latest winter forecast, again, it sort of feeds into what I was talking about here. September is going to be quite calm, October, November, reasonably mild, and some of the forecasts allude to that. But again, late winter, so we're talking February, March, could be a lot more active, and we could see some colder spells, and obviously we don't need that at the moment. Russia, I didn't want to leave without speaking about Russia. Obviously, finally showed its true colors, and we always heard this tagline that they were a reliable supplier. Well, you can put that in the bin now because that is not the case, and we can really see the big drop in the Russian volumes now, and all we're getting now basically is Velké Kapušany flows, and obviously Turkish Stream, but we're looking at Northwest Europe here. You're getting Velké Kapušany at 375 gigawatt hours a day, and we know that they could push volumes through other routes. They obviously halted flows through Nord Stream. They could have pushed it through Sokoranka, which they also halted. We know about Malno situation as well. So yeah, what we're getting now is merely a trickle of gas from Russia at the moment, and the drop-off is quite stark, to be fair. And also you can see their production is really starting to fall from sort of the Yamal fields, and here we are, the latest figures that we can get our hands on. You can really see the drop-off in production. And I think, lastly, this is one thing that's quite stark, really, and also quite sad, that since actually they invaded Ukraine, their actual earnings have gone up, and it's quite scary, the returns. So they reckon they'll be earning 337.5 billion this year. Now, this is not just gas, it's energy exports. 38% increase. 2023 is still forecast at $260 billion. And you just think, 2021, when they were supplying at this full tilt, 242 billion. So the war has actually helped them increase revenues way beyond what we've seen in the previous 3 years. So it's quite a sad effect of the war, that they're actually making more money. And it kind of underscores the fact that we really need to move away from Russian volumes to stop financing Putin and his illegal invasion. Conclusion, I think I'm close to time now, I think. Again, some simple ones here, but without Russian gas remaining extremely tight, we're looking at this will probably likely to stop next. LNG is the main source, but can it help replace lost Russian volumes? We'll only see. Strong increase in regasification should help bring in more LNG, but it won't fully offset it. Demand disruption is needed. EU measures can impact. We don't think gas price caps would be the key to this. Other notable risk, China, will it return to the spot market? Demand is still suppressed. The zero COVID policy is still in play, and some cities are still locked down, but there's talk of demand resuming October, November, later in the year. And again, we're talking about French nuclear concerns, which I'm sure people will cover in more detail, low renewable generation. If we get a beast from the East scenario, I think we'll be in huge trouble. Any extended production outages in Europe, and of course, one thing that's quite key actually is disruption to US LNG exports now that we're so over-reliant. And lastly, I'll just finish with how I started, with a few new faces this time. So I've got the favorite guy in there. We've got Biden. He's quite against, obviously, Russia, and he's all about getting the LNG. We've got this man, I don't want to give him any words, to be honest, but he's obviously remaining key to what happens, and the latest talk about mobilization and all this nuclear rhetoric is quite scary, to say the least. And here, if we take a look at the latest JP Morgan Global Composite Output, it's the first time the global economy has gone into contraction, so below 50, since, as you can see, the pandemic. So signs of that as well will also feed into demand of all fuels as production starts to falter. We've seen big impacts of that in Germany. And the coal market, as Diana nicely explained, is still here and still going to play its part. And of course, China, what will we get from them in terms of demand reductions? Will they support Russia? So there's a whole lot going on. And of course, she'll be making some impacts as well in terms of all these proposed measures. And so, yeah, overall, a lot has changed in the last 3 years, but I think looking at what our preliminary research so far shows, and for those of you that are clients of ours, you'll see our winter outlook will be published next week, where we'll have a real full zoning on everything that's going on. But overall, I think for us now, looking at 2022 and beyond, I think weather's going to play a key part, as is the war and many other of these factors. Thank you.
Thank you very much, Wayne. Excellent. Thank you, Wayne. As ever, an excellent overview, very comprehensive look at the main factors driving the gas market.
There's a lot going on.
There's a lot going on.
Indeed.
But if I can just ask you, the storage facilities are, on target. They're filling up. Is that a cause for optimism? Would you say for you?
No.
No.
Really? I'll be honest, but no. But only because, like I said, I showed in that other slide, the difference between the LDZ demand, looking at the weather scenarios, is equivalent to 55% of storage capacity, etc. So yes, it's a good thing, but as we've seen the last few days, we've seen a real uptick in demand. So all this talk about demand reductions, we're seeing it got a bit cold. Everyone reached for their heaters now. That might change later on in the year, I'm not sure. But it's the storages are there, but I think German storage would empty in 2.5 months, if I'm right, if no other sources. So no, I don't think it will be enough. And again, I can't stress or emphasize how important the weather's going to be, because if we have, and I always keep saying it to the guys in the team, that a beast for the East comes, we're in huge trouble. Yeah. In light of, even if the LNG does come, that demand we saw over those few months, and I remember how strong it was, we would not be able to cope with it, and it probably would lead to shortages.
Yeah, absolutely. Any questions from the floor for Wayne?
Great.
Yes.
Hi, I'm Annelieke from Energy Stock, and I
Hi.
was just wondering, how do you look into at the gas market in terms of flexibility now that there is storage levels locked in and there is less flows from Russia coming in? Will there be enough flexibility for the coming winter?
We don't, at the moment, it's not. At the moment, we do. Like I said to Richard, at the moment, we're doing okay. But again, if you look at some of the figures from this year, softer non-LDZ at record lows, softer LDZ demand. We've seen a lot of companies fall out of the market. We've seen a lot of halting of production. So at the moment, it's going okay. But I think we've run in quite a few scenarios, and I've seen some of the early results. And one of the results was looking at extreme weather, and we're out of storage by February. So this is, again, preliminary, but so there is flexibility at the moment, but in the light of a huge demand surge and perhaps a drop in one of the other supply sources, so say there's huge outages in Norway, for example, that's going to cause a big problem because Norway has stepped up over this last year with record exports to Europe. UK is also could have an impact as well, because as I mentioned, if you look at the discount, it's around 200 pence a therm, or it's been higher, probably 150 to 200 now. That means the UK will continue exporting. Actually, the UK has been helping refill German storages by way of importing LNG and sending it through the interconnectors. So at the moment, yes, we're doing well, but I think when you mention the flexibility, that will be put to the test if we see any sort of outages, etc., supply disruptions or extreme weather in terms of demand. And again, don't forget Asia. If the Asian weather ramps up and we start competing again, we could see less cargoes coming to Northwest Europe as well. So yeah, at the moment, the flexibility is helping.
Excellent. Wait, just a final question. The new UK government has announced a return to fracking. Is that gonna save the UK or Northwest Europe? Wayne?
No, I was reading about that this morning. Yesterday, there's been a lot of talk about it in the news. I think one person said it's impossible, and I think yesterday the energy minister said, no, we're going to look at testing the seismic activity. Think of fracking in America, and you look at the infrastructure, etc. Now you think of where they're looking to frack in the UK. Number one is the damage to the environment around you. So obviously you've got these small villages in the northwest of England where there's a lot of this gas supposedly there. You're ruining them villages. You're bringing in trucks with sand and water, then you're taking them out. Also as well, in the US, if you have gas under your land, you get compensated. In the UK, that's not the case. So when you've got all these, people against it, why would you, if you lived in this small village where there's a lot of gas, why would you care? Maybe you think, it might help with the UK situation or help with the European situation, but you're not going to gain financially out of it, but you're going to get a hell of a lot of disruption to your quiet, quaint English village. Now, I think that's the problem, is the size of the UK and America is so vast, and you can get away with digging up large swathes of land and bringing all the infrastructure without causing significant damage to local communities. And again, they're financially recompensated as well. Fracking millionaires, I think they call them. So.
Absolutely. So a nice idea in theory, but
it's a nice idea in theory, but I'll be amazed if it goes through. There'll be a lot of red tape that has to be cut through, and persuading a lot of local councils. There's a lot of layers to UK politics, and so it'd be quite tricky. But it's encouraging they're talking about it, but I wouldn't hold your breath.
Yeah. Perfect, Wayne. Thanks again. Here's a little present from us. Thank you.
Thank you.
Yeah.
Cheers, mate.
Cheers, Wayne.
Very nice. Thanks.
So we've moved from power prices to coal and gas, and now we're going to focus on carbon. As other commodities have risen quite substantially, as Wayne and Diana have shown, carbon has fallen. It threatened to touch 100 euros a tonne earlier this year, but now it's fallen back down to around 70. And to talk us through the reasons for this and the outlook for the coming months is Lawson Steele of Berenberg Bank, a well-known name in the carbon market. And I think, he will talk us through. He's with us virtually. So a warm welcome to you, Lawson, and I'll pass over the floor to you.
Thank you, Richard, and thank you, Montel, for having me. Apologies for not being there in person, but it's my son's 30th birthday. Obviously, for those of you doing the maths, I gave birth. Well, I didn't give birth. My wife gave birth when I was 15. Just kidding. I should point out I'm no longer with Berenberg. I sort of left, retired, call it what you like, back in February. But it means that I can devote myself to carbon, which is what I've done for the last 18 years. And do it the way I want to do it. So, you know, the question here is the topic put to me is, you know, the outlook for carbon prices, given the current sort of high energy prices, and what could happen to upset the carbon sphere. So the four key messages I wanted to get through. You know, first of all, the EU ETS is the cornerstone policy as the EU combats climate change. Secondly, trying to control the carbon price in order to control electricity prices is really a fool's paradise. Thirdly, it is all about the supply restriction, which is the principal driver of the EUA, rather than what's happening on the demand or emissions side. And fourthly, I still expect the price of EUAs to rise significantly. So first of all, I thought it was worth just stepping back and sort of understanding what the raison d'etre is of the EU ETS. It's ultimately about saving the planet. And it's kind of interesting to look at things at the moment. You've got the selfless versus the selfish. The selfless is, of course, we need to save the planet. The selfish element is everybody's looking short term and saying, well, I'm in pain at the moment, so I can't think about saving the planet. But eventually that will come back to probably not bite you and I, but certainly will bite, you know, the people who follow us on the planet. So, yeah, it's just worth sort of bearing that in mind, I think. Secondly, you know, the EU ETS is absolutely critical to the EU's climate policy. The EU, as a reminder, is leading the world in reducing emissions. We took that view back in 1997 at the Kyoto Summit and followed it through with the ETS as the prime weapon to do that. So the other thing which is really key is that, you know, this is a massive source of revenues to countries' budgets. We're talking about at the current price, which is 69.70, you know, that's about 48 billion or so of euros. Now, to put that into context, that's more than the UK Brexit bill of 40 billion. And what's more, it is a recurrent revenue stream. And if I'm right, it's going to increase. So that is money which is coming in, collected by the EU and distributed to all the member states. And it is an important, really important, not just for economic budgets, but it's helpful to assuage the impacts of these high electricity and gas and coal prices. So it is, if you didn't have that 50 billion per annum, we'd be in a much worse state in terms of trying to help the poor. So but finally, I'd say, you know, this is not the reason why energy prices have gone up, and I'll obviously show that in a second. So, you know, if you look at the electricity price over the last 15 months, it's gone up 710%. You can see that's the actual electricity price there, the same on the chart below. This is the carbon cost down here, and this is fuel plus margin. In other words, gas price or coal price, depending on where we are. As a percentage of the total electricity bill, this is 4.9%, right? Not the electricity bill, but just the generation cost. So if you're trying to control the carbon price in order to control this high electricity price, it's absolutely irrelevant. I mean, if you reduce if you halve the carbon price for the sake of argument, then all you're doing is reducing this ridiculously high electricity price by 2.5%. So it really is not, it's not going to solve the problem. And then, of course, you kiss goodbye to all those revenues, and that means that you won't have, you know, the budget to help the poor. So this slide is really about, you know, the fact that really it's the supply reductions driven by the MSR mechanism, which are driving a tighter market. And this was put in place by the EU in order to make sure that the carbon price was sufficiently high, which it still isn't, to induce more efficient, less carbon-intensive processes to be built by or put in place by industry. So as a reminder, we're still not at a carbon price which is going to be delivering that. But if you look at the different demand and supply drivers, I put a subset of UK-driven demand drivers. You've got the gas to coal switch. You've got lower industrial output, of course, because of the economic impact, and now the debate about extending nucleus. At the same time, you've got dry hydro conditions for this year. Eventually, you will have an improved carbon intensity by industry, but I think that's more down the line. And the supply drivers are Ukraine-driven. You've got this idea of selling additional allowances from the MSR pool. The MSR is this Market Stability Reserve, which essentially every year takes supply out of the system. I should have explained that, but sometimes when you're used to these things, you're sort of deep in the woods and you forget about explaining to people who are not so familiar. But the idea is that that there will be additional supply come onto the market. This is what been proposed by ENVI within the Parliament, but then has to be debated by Parliament, and then eventually has to be also via the trilogue agreed with Council and the Commission. So I think the probability is low, but it's certainly raising its spectre at the moment. But we were talking about 20 to 30 billion euros, which is a really odd thing to say, because it's not actually. It should be stating the number of allowances rather than the amount of euros, because the euros would depend on where the price of carbon is. So, if we're talking about, for example, 20 billion at today's price, that would mean 290 million additional allowances, but the price would probably drop to 50, say, and therefore you need 400 million allowances. So it's a silly sort of a way to express it, I think, but it's politics, so it is what it is. The MSR, to just give a bit more colour, that kicked in on the 1st of January 2019 after 4 years of debate, and that essentially under certain conditions produced a supply in the market. We're talking about 300 million or so, 350 million per annum reductions in supply to sort of take out the excess liquidity in the market, to therefore tighten and increase the carbon price to a level which actually triggers carbon reductions. And then finally, you've got the Fit for 55 package currently being debated. It should be in place by probably end of the year. At least the debate should be finally tightened by then, by which time we should also have the MSR, whether or not this MSR 20 to 30 billion is going to come in or not. But that Fit for 55 package is a pretty significant, clear indication of what the EU is trying to do. The original target was to reduce emissions by 40% on 1990 levels by 2030. Now it's 55%. And interestingly, the impact on the EU ETS scheme is not a 55% reduction, it's 61%. So in other words, they're putting more of the brunt on the EU ETS industries, which are about 40% of emissions in Europe, and they're putting more of the brunt on them to reduce their emissions, and therefore, by implication, less on the other 60% of emissions. So this is my final slide, so I've left time for questions. This is what I think. I think the EUA price, carbon price, has to go higher in order to have an impact on corporates to reduce their emissions. But of course, it will be dependent on these political outcomes I discussed, the MSR, the Fit for 55 package. We'll definitely have volatility continue, which is why I have a range there. So the shaded area is telling you that the carbon price could be anywhere in that range, and ultimately could be exceed this level. But broadly speaking, I think we're going to continue to go up. I turned bullish on carbon when it's at €8 back in 2018 and in January 2018, and we continue to go up with the volatility inherent. As you said, Richard, we got to €98 or so before Putin then sort of opened his mouth and said we're invading Ukraine. And then it's kind of interesting just to know, you have, when we're at 98, the first thing which happened, of course, was that the US and everybody else said we're going to exclude Russia from switch accounts. So the first thing Putin told his cronies to do was, you have 2 days to get rid of your any positions you have in whatever it is, which included carbon. And you saw immediately about a 700 million trade when it was at 98, which precipitated then the whole domino effect down to about 56 or so since when it's recovered. But anyway, that's it. I think the carbon price has to go up if we're serious about saving the planet, which the EU certainly seems to be so far. So I'm not seeing any backtracking on that. So over to you.
Perfect. Thank you very much indeed, Lawson. The first question I'd like to ask you is really about the role of speculators in the market. I mean, this has been quite a hot topic over the past year or 2 years, certainly as prices moved back up after their post-COVID or their COVID lows. Are they back, and are they shorting the market in anticipation of a recession, would you say?
There's always an element of speculation. First of all, we had a proper, or ESMA, the market regulator, did a proper in-depth look at the role of speculators and concluded that there's nothing untoward. Secondly, the level of speculation, of financial speculators, and I'm deliberately saying financial, and I'll come back to industrial in a minute. Financial speculators have certainly sort of pulled away a lot, just because, generally speaking, everything they have, all the portfolios, they've had to retrench. So I think the level of speculation at the moment is, or financial speculators, is low. Could there be some shorts? Of course, there's some shorts. There's always going to be some long as well. That what makes the market. Thirdly, let's not forget that industry speculate, right? All these large industrial groups all have traders, and what do traders do? They trade, right? So yes, they're buying, say, the carbon allowances required for their company, but also they will be taking positions, shorter term around that. And I know all these guys. So to just talk about speculators and think, oh, it's just financial speculators, it's not. And lastly, you need these guys, right? You need liquidity in this market. If you had no speculators, if you removed all of that, you'd have single trades here and there. You'd have enormous volatility, and you wouldn't have much liquidity. It'd be a disaster. So it's all very nice to say, oh, it's the speculators, but underlying all this is that the fundamentals been radically changed from the 1st of January 2019 with these annual supply reductions. And why? Because they wanted to get the carbon price up. Because let's face it, this system has been a complete disaster for the last 15, 17 years. It's achieved nothing, right? So the only time it achieved something really wasn't about, which I predicted, was in 2020 when I said that, all coal production of electricity would fall to almost zero, or to the bare necessity, and gas would take over, which is what happened. Now, of course, we've got completely different dynamics because of the lack of gas supply. But that's the only thing it's achieved. I mean, industrials have had these fantastic subsidies because they only have to buy 10% of their carbon allowances, and they're getting 90% for free over the last 15, 17 years. So they've had no motivation to reduce their emissions. So, ultimately, the carbon price has gone up because of fundamental reasons. And I think speculation should be, that's how you make price discovery and how you provide liquidity to the market. And I think that's really important.
Absolutely, thank you. And if I can ask you also, I mean, we had a lot of economic indicators globally point to a downturn, recession. We had the previous presentation pointed in that direction. but you are predicting prices to over 100 euros a ton for carbon in the first quarter of next year. Could you explain that, how that, even despite a recession, you think we could be heading far north in terms of carbon prices?
Yeah, I mean, you know, I've put in I'd already put in back in June or so, or maybe it was May, whatever, a 3% fall in industrial output in Europe, which effectively meant, I did in June, which effectively meant we'd have a 6% fall in H2. And I got a 5% fall next year. But as I said, this is a supply-driven market. So the demand, whether the emissions will fluctuate, of course, but they are not significant compared to what's happening on the supply side. And you know, the other thing to take into account is, yes, the output of industry is falling, but we've also got a massive switch from gas to coal, which produces twice as much carbon as gas does when you produce electricity, and that is kind of offsetting that. So ultimately, we are short this year, and unless they're going to come out of the blue and sell 30 billion worth of allowances in 18 months via this MSR proposal, which I think is rubbish and ludicrous and will kill the market if they do that, then this has to go up.
Yep. Thanks.
It's just, I mean, it's simple.
Absolutely. Any questions from the floor here? Yeah, Nathan Whitcop, Montel News.
Hello, Lawson. I was hoping to actually ask the last question that Richard asked, but you've gone and answered that. So if you wouldn't mind, I wouldn't mind getting you to follow up a little bit there on the point that you just touched on, which is, of course, in the middle of this crisis, you have a lot of political pressure to do something about energy prices. You pointed out carbon's a tiny component, but it's the most tempting component for many politicians, and it's low-hanging fruit. We're going to see some form of sales out of the MSR. Surely this is going to have an immediate short-term effect that makes these kinds of prices next year very unlikely. How do you respond?
Well, I think I don't think it's a slam dunk. So I'll answer that in a sec. But it depends which one. There are sort of two ideas at the moment. One is that you raise 20 billion over 4 years. And then, you know, I think a couple of weeks ago, whatever, Peter Liese came out and said, we want to do 30 billion in 18 months. Now, that's obviously a much bigger hit. And hence why, going back to my prices, I have a range around the central scenario. But don't forget, you know, this is nice. It's crazy. There's lots of noise at the moment, and it's very easy, particularly in this modern world, for somebody to say something and everybody think, oh, that's where we're going. So we've had Poland make a lot of noise. You know, Poland seem to be on a general, i.e. not just carbon-specific EU attack, let's call it that, where they're looking to get all sorts of things go their way, and the EU ETS is one way they make noise, amongst others. But you know, so far what we're hearing about this MSR proposal is coming from the Environment Committee, which is within Parliament. So they can go and propose this to Parliament, but as we saw last time, Parliament said, don't be ridiculous, go back and get a proper consensus thing, I can't work with this. So that could happen. And then you've got to get Parliament, Council and Commission to agree this. Now, Council and Commission are very close to the law, and this is a departure from the law. I'm not saying it can't happen, and I agree that there are political there's political will here and there to make it happen, but I don't think it's a slam dunk by any means.
Lawson, we're running a bit out of time here, so I'd like to thank you once again very much for the presentation today. We've got some very interesting months ahead, so hopefully we will talk again before not too long. But all the best. Enjoy your son's 30th birthday, and yeah, all the best. Thank you.
Thanks very much. Sorry I couldn't be there. Cheers.
as I just mentioned, we are running a bit ahead of, well, short of time, but I'd like to have a 30-minute break now for, and we'll come back at 1:45, and then we'll talk a bit more about LNG markets. So see you then. Thank you. Hello, hello, and welcome back. I hope you're all suitably refreshed. I think this is what makes it so good to be back, is that we can have coffee and some snacks and talk in the breaks. That's not so easy on Zoom or Teams. Now, to take us to lunch, we will first focus on a little bit more on LNG, zooming in on LNG, and then we'll have a panel discussion debating a variety of relevant topics for Germany in terms of what's going on with its neighbours and also the weather situation and climatic change. But first of all, a warm welcome to you, Henning Gleustein of Eurasia Group. You will talk to us about LNG. Are we locking ourselves into infrastructure here, or is it a short-term solution to the energy crisis? Henning, the floor is all yours.
Thank you, Richard. Thanks for the invitation to speak here as well. It's great to be back. I was actually born in Düsseldorf, so it's a home visit for me. If you don't know Eurasia Group, I'm not going to do a long spiel here. We are political risk analysis folks, which means for all the wrong reasons we are quite busy at the moment. And I look at the energy, climate, and resource space in that area. And indeed, we'll have a look at the LNG sector, and we're approaching the last quarter of the year, and are there some lessons that we can draw from this? So the first thing is, a 90% supply cut by the biggest supplier of European gas has taught us a few lessons, and whether we like this or not, and I don't work for the LNG industry, so I'm not going to try and sell their book. Some people don't like it, but LNG is locked into the European energy infrastructure for a long time now. There were people who, until fairly recently, doubted that, but just the need to phase out all that Russian gas. Wayne just mentioned it as well. I mean, it's so obvious now. The amount of LNG terminals, import terminals that are being built already tells you the money spent, the political will dedicated. It means LNG is part of the transition now, whether you like it or not. Second, so there's a few spoiler alerts. Market forces alone, because of the severity of the situation, are currently not able, i.e. insufficient, to ensure supply and demand. That's a very uncomfortable truth, because, of course, policymakers, including the European Commission, have spent the last 15 years telling everyone in Europe that market forces are always able to ensure supply and demand, and that is looking a bit wobbly now. You can't really accuse them of not foreseeing this, because I don't think many people foresaw that Russia would really cut virtually all gas supply. But it's happened now, so we have to deal with this situation. And that means that the emergency measures that we are seeing right now being undertaken by the European Commission, or planned at least, and also by several governments in the EU and also the UK, will lead to permanent market reform. That means that we will probably not return to a market that we are used to, that we have seen so far. And that has really heavy political and market implications for everyone involved in this industry. Now, just to sort of update you, most of you, well, I'm sure virtually everybody will know this, but basically what Europe is having to do right now is 3 things at the same time. And each thing of these alone would be really difficult to do. So first of all, there's the emergency management. We have to get through next winter, and probably the winter after that, somehow without rationing or load shedding or whatever the situation is. Our view at Eurasia Group is, at best case, this is recessionary. So Q4 and Q1 this year, next year will be a recession. That's the best case, because it's just the cost impact that this effort means. And in the worst case, it's an industrial derailment on a pretty epic scale. The next thing that we're trying to do across Europe is an orderly decoupling from Russian gas, so a phase out. That will take anywhere between 1 and 5 years. Remember, the European Commission in March said it'll work by 2027, but the reality now means it probably has to work pretty much now. And so that in itself would be a massive undertaking as well. And then you've got, of course, the full decarbonization of Europe's industry that will have to be done at some point over the next decade or three. Also hugely costly. Now you can see here, in two of those things, LNG does play an important role. So you can see, of course, that LNG, and Wayne already showed this, plays an absolutely crucial role in phasing out Russian gas immediately, and it will play an absolutely crucial role in providing baseload electricity, basically, for the next decade and a half, probably, until we can get all the alternative supplies, whether it's nuclear, whether it's hydrogen, whether it's batteries, or a combination of all three. We probably won't get away without LNG, because, especially if we want to start phasing out coal again, as we just saw, hopefully from 2025. It's very impressive that in this area, lignite and hard coal has been ramped up. If you fly into Düsseldorf, you can see all this stuff steaming again. But it's also, of course, a sad reality, because it means that Europe's emissions are going up again, and also so its coal imports are increasing again, which is another cost factor. So this is the reality that we are facing, and this means that LNG absolutely plays a crucial role in Europe's energy transition over the next decade or two. I'm going to do a inward-outward zoom now, what this means for the world. This is a study from Amprion, one of the grid operators active in Germany. This was published earlier this month. If you don't speak German, I'm happy to translate it, or if you email me. But basically, you can see here that the northeast of Germany has an excess in electricity supply, so they'll be fine without rushing up. Fine is not the right word, but they're fairly well prepared. And the further south you go in Germany, there is an import need of electricity, because they sit on the Russian gas pipeline, they don't have any coal, they don't have access to offshore wind, and of course there's no direct access to LNG terminals either. And this means that normally they would import from France, but we've already heard that actually France is currently importing from Germany because of those nuclear shortages. And this tells you that within Germany, the supply risk this winter is skewed to the south massively. You can't just put Germany into one risk area. It is much more a south high risk versus a north much lower risk. And LNG is an important factor here, because where we are right here in North Rhine-Westphalia, of course, there's no LNG terminal either, but the Dutch terminals are quite close. Rotterdam is fairly close. Eemshaven has been operational for 2 weeks now, very impressive. They built that in 6 months. Is around the corner. Zeebrugge isn't very far. And there you can see that the industrial area around this area will rely heavily on LNG. And of course, hopefully, towards this winter, the northern German terminals will come into place as well. But in the south, this is going to be much more difficult to handle. It will have to involve reverse pipeline engineering, which will happen. We can see that the first cargo that went into Eemshaven in the Netherlands, half of that gas will actually be supplied to Germany and the Czech Republic. That's why the Czech Prime Minister was there for its opening. But this will be a huge cost, but it does, again, it tells you that LNG will play a key role in phasing out Russian gas. In Germany, a country which doesn't have any LNG terminals at this stage. And here's basically, you can see what the risk exposure is in Europe. It's a bit of a map that sort of my son could have drawn there, apologies for that, but you can basically see a rough risk map there, and the exposure within Europe to winter shortages is heavily skewed to areas where you don't have access to LNG. It's Central Eastern Europe, so Bavaria, Austria, Czech Republic, Slovakia, Hungary. And if you go sort of further away from the Russian gas pipelines, and also to areas where there are LNG import terminals, you can see that the risk exposure to winter shortages is much lower. With the odd example of exception of Britain, where Eurasian Group sees a very high risk of winter shortages, despite the fact that they have LNG terminals and Russian pipelines don't rely on Russian pipelines. The reason is that their storage capacity meets demand for a couple of days versus a couple of months in for instance, Germany or Italy. And on top of that, their power reserves is largely made up of natural gas. So if there's, if they have to bring power in to meet demand, but there's no gas, they don't really have much in sense of reserves. And there's been no political will to address demand reduction, as we've heard, is absolutely necessary next winter. The UK is just capping prices and saying it's fine to consume. It'll be good if you want to sit alone in winter in your pants and t-shirt, that's fine. And that's not going to work. But anyway, overall, you can still see the exposure and the access to LNG terminals will be absolutely crucial, not just this winter, it'll be crucial next winter and the winter after that, until sort of the European market has settled and rebuilt all its supply chains. The good news there is, though, and we already saw this a little bit earlier, is the amount of LNG terminals being built in Europe is crazy. As of July, 9 terminals were under construction. One of those, Eemshaven, has already been completed. There are more than 20 proposals at the moment for new ones. Now, of those 20, I don't know exactly, but I'm sure at best half of them will actually be made. But even if that happens, that the number of LNG import facilities across Europe might double over the next few years. And we saw Wayne already earlier with the slide with the capacity increases, which will tell you that, again, it confirms LNG is already locked into Europe's energy future. Even if peace broke out with Russia next week, which we really don't expect at this stage, but if that happened, for sure, some Russian gas might come back to Europe. And I just had a conversation, in the long term, it's probably important that one day we factor in again a partnership with Russia, because you can't just ignore that big neighbor. And country that we stand in here right now, also worth remembering, started trading again with the rest of the world 3 years after World War II. But still, the decisions and the political will and the money spent on LNG infrastructure now means that it can't be reversed anymore. This will happen, again, whether one likes it or not. I do want to spend at least a few moments on what this means for the rest of the world, because it's quite dramatic. We've already heard this earlier with coal, and it's the same with LNG. Emerging markets are being priced out of LNG at this stage. This is a brutal process. So Pakistan, for instance, has struggled to attract even single cargoes for much of this year, which has caused blackouts across Pakistan. You might remember, in all this war in Europe, we're focusing very Eurocentric at the moment, but Pakistan suffered temperatures of 53 degrees centigrade earlier this year. Then now a third of the country is flooded, and they've got power outages because they can't afford LNG. We also see a sharp reduction in imports. Bangladesh, India, Thailand. Thailand, a very recent market entrant into the LNG market. They saw this as a means to push coal out of the system, to be good, reduce pollution, combat climate change, and now they say, we can't afford any of this. And this is a very brutal process, because it means it really undercuts growth and livelihoods across emerging markets in the world, because of Europe's desire and urgency to phase out all the Russian molecules and hoover up any LNG. It's a necessity, but it is a brutal necessity. And this doesn't just mean for South Asia's emerging markets a bit of an inconvenience. It's actually a real economic problem there that I think sometimes, while we worry about our problems, is worth keeping in mind as well. Now, back to Europe, though. It's really important, and this is the markets here, to just be aware of what's happened, not just in terms of kinetic warfare, but if you look at sort of definitions of market manipulation, is willfully withholding supply to raise the price is one of the core definitions of market manipulation. And a 90% reduction in gas supply to Europe is an epic wholesale market manipulation as has never been seen before. And Wayne already mentioned this, but here's a headline from Bloomberg the other 31st August, so just a couple of weeks ago. Gazprom is booking record profits over this, despite a 90% reduction in prices. This tells you that if you're a European regulator, that you cannot continue operating the market. If you have the single biggest supplier breaking your market willfully, you as a regulator cannot continue to ignore that and just say, we'll continue trading because that's what we do. It doesn't work like that. And you can already see the live impacts of this. So market signals don't really work. So I know market structures, the curves change, but you can see here, this is a few weeks ago, that just the incentive of buying storage now, gas now and putting into storage, that incentive isn't always given at this stage. Normally seasonality will tell you gas is cheap in summer, that you buy it cheap and you put it in winter and sell it more expensively. It's a beautiful model. It's broken. Under vast weeks of this summer, the price was so high that actually the market's incentive would have been for everyone to sell gas out of storage immediately and just make a lot of money out of it. Wonderful. And the reaction has been that the regulators, the government in this case, had to come in and mandate storage buying at no matter what the cost is, which again contributed to driving the price even higher. Because if you as a trader know that the German government is mandating storage injections at whatever the price is, you know you can lift the price. It's a natural reaction. So the market signals didn't work, so the government had to intervene. The marginal cost, it's already been mentioned today, but this is a huge problem. And I know there's a couple of power generators here, but so a lot of the electricity that is being generated right now by utilities was actually sold a year or two ago at 40 to 50 euros a megawatt hour. So, and now they have to go and hedge part of their production at whatever, 400, 500 euros a megawatt hour. And this is where you're seeing all these margin calls and where utilities are literally running out of cash, and that's why national governments, the EU and the UK also have said they're going to have to provide liquidity support for virtually every utility here, because this is basically the price difference you have to be paying in your hedging industry. And again, this means that a tool that was originally designed as a financial safeguard is now becoming an existential threat to parts of the industry, i.e. the market's not working. And then, of course, you've got the marginal cost model. Now, please, I have to state here, this is not a live model. This is a model that is circulating in the European Commission at the moment, just to highlight the issue. In the past, the marginal cost model was working because the lowest cost producers, let's say, was producing at 15 cents per kilowatt hour, and the highest cost producer maybe at 25, 30. And somewhere there, the wholesale price would reflect that reality. That is totally broken now, because prices have gone so high that the lowest cost producers, who've managed to decrease their costs again, so the cheapest renewable folks, some nuclear and the lignite industry as well, they can produce at extremely low costs and are making vast profits. It's not their fault that Russia invaded Ukraine, but they're still making profit. And at the same time, of course, some people in the industry who were relying on Russian gas to fulfill their customer obligations are now having to go into furiously expensive spot market to replace that gas. And so for them, that's not a windfall profit, but that is a catastrophic cost factor. And again, that is why companies like Uniper run into serious financial difficulty. And they won't be the last, and they weren't the first. So again, you have a market intervention, government liquidity support, the price caps discussions that are happening, and so forth. And again, all this is telling you that the market as currently is broken. And this is a reality, again, whether one likes it or not, that one has to live with. And it will probably not go away, as you can see by the European Commission's decision when they announced their measures last week, that they were saying at least until the end of 2023, which basically tells you probably 2024 as well. And it's something that we'll just probably have to get used to. Now, where will this lead? I mentioned right at the start that the emergency measures now will probably lead to long-term reforms. I have to again stress this is not a well-developed final approach. It's just something that's circulating at the moment. But we will probably see some market reform. So, for instance, when you heard during the first presentation that power and gas prices will probably be linked until the end of the decade, I'm happy to discuss that, but I actually think they won't be linked to that extent by 2029. There might be for another year or three, but at some point there will be market reforms, because these were planned anyway. The more renewables you push into the system, even without a war in Ukraine and Russia cutting you off your gas grid, it was challenging and eroding the existing pricing model. So there were already plans in place to start market reform, probably about 2026, and now they're just being pulled forward. So the most common model that we hear from policymakers, again, they're very early stages, so this is not necessarily what will happen, but the most common form you hear is that you will have different pricing systems. So you'll have an essential supply contract, which is also reflected for you and me as a retailer, retail consumer, which is priced off low cost and low carbon energy. So renewables, in some countries nuclear, and plus the storage costs, like batteries, maybe at some point hydrogen. That will be quite cheap, and that is retailed to you as a retail consumer at a fairly low price. Then you have the additional supply, which will probably again be priced off long-term supply contracts. We know that the Norwegians and the European Commission are negotiating a fixed winter supply contract supply price right now, and the Algerians and the European Commission is doing the same thing. And that will probably form the basis for a sort of additional long-term price that flows along the seasonality, as it did in the past. Very uncomfortable reality for the European Commission, because it upends a trend that they, 12 years ago, through many arbitration cases, said, no, we don't want long-term contracts anymore, we want spot market contracts. Awkward, but it's the reality. And then finally, you will probably see some form of short-term needs priced off a spot market, which will be kind of like a JKM Europe. So that would be the Japan-Korea marker for Northeast Asian spot LNG. You'll probably see something like that being developed in Europe. The European Commission has already said that they might want to look at reforming TTF, and that will be the price for shipped imports of LNG and eventually either liquid hydrogen or liquid ammonia, but this is talking many, many years down the road. And that could be hugely expensive. The European Commission is fully aware that this has to be expensive, because we know that we have to attract the LNG cargoes in winter at short-term need, pricing against Northeast Asia. It gets very cold in Japan and Korea and China, so that has to be in place. That can't be a long-term contract. If we need the gas, we need to pay for it. But the idea there is that in some form of future price modeling, the biggest part of your contract is the essential one. So that is a cheap one. If that makes up about 60% of your bill, and then it gets topped up in a cascade, then most providers will have an incentive to have as much access as possible to the cheapest and conveniently also the cleanest form of energy, and only tapping into the most expensive one when it really needs to. So this is, again, this is not the final document, it doesn't exist, but this is the sort of discussion you are seeing in governments and at the European Commission being talked about right now. And of course, this is a little bit sort of cautious optimism at the end, because don't want to see doom and gloom about everything, but it is worth keeping in mind, and we just had a carbon presentation as well, the policies to implement this sort of stuff. And they are not being derailed. Every single major economy across the EU, and again the UK, and the European Commission keeps telling you that, yes, we know we're ramping up coal, but we will double down on the green transition. So what you're seeing again is sort of the 5-year targets. They're all out the window, because we know coal, those coal-fired stations around here, they won't be switched off next year or the year after. Maybe 2025, indeed, as we've heard. So those targets are going out the window. But because of the doubling down of the investment, so they're trying to basically front the CapEx, front the investment load, to reduce the OpEx later. And so you will probably see a sort of a hockey stick curve at some point, which will see, because all the investment now will see a rapid expansion of green technologies towards the middle and latter half of this decade, which means by 2030 we're probably back on track with our transition goals, and then we'll probably see an acceleration, not a deceleration. And you can see this by the policies being implemented, the 3 main tools, and it's worth just to keep in mind, subsidies. All subsidies currently support clean energy transition, whether it's EVs, hydrogen, renewable power, incentives for efficiency gains at home, they're all green. Penalties. The carbon market is a form of penalty, and as we've heard, the price pressure is probably more on the upside than it is on the downside. And then, of course, there's bans, just banning stuff. We all know that electric vehicle sales are being not just subsidized, but we also know that internal combustion engines their sale will be stopped within the next, depending on where you are, 5 to 15 years. So, and this combination of these 3 measures will enforce a green transition. It's the regulatory foundation that will happen. And my last slide with a bit of optimism there, it is worth keeping in mind when you hear people saying it's totally impossible to do this, a lot of possible things have happened over the last century and a bit. Before basically 1900, there was a stagnant energy consumption for thousands of years. But we saw within 50 years, we saw the energy revolution kicking off with steam and coal. That was unprecedented change from human history. Between 1900 and 1950, the electrification of vast parts of industrializing areas of the world, Europe, Northeast Asia, North America, and then 1950 to 2000 was the global oil boom, which was unprecedented. You could fly around the world quite easily and affordably, totally impossible just years before. And now, the 50 years between 2000 and 2050, we do know the technological solutions that will bring us there. Yes, they cost a lot of money, but if you invest, keep in mind, technologies get cheaper and better the more you use them, unlike fuel, which gets more expensive the more you use it. And so we are quite optimistic that this green transition will work, and we actually think that this crisis will accelerate the green transition, but it does mean LNG is a key part of it, especially in Europe for the next 10 to 15 years. Again, whether we like it or not, but that's the reality that we are facing now. I'll end it with that, and thank you very much for your patience, and if you have any questions, let me know.
Thank you very much, Henning. Nice to sort of end on a note of optimism there as well.
Have to.
Yeah, absolutely. The first question, relating back to the UK, and you're talking about storage in the UK, what's your view on Rough here? Because there's talk about that coming back. I mean, it's starting to come back, isn't it? Will that have any effect on the storage and the situation in the UK?
Yeah, once it's back and once it's full.
Yeah.
Sure, but bringing it back now, I mean, you know, the physicality of how long it takes to fill it up, I mean, won't probably make a vast difference over winter. The only thing it might do, though, is, and this is actually detrimental for the EU, is it might actually reduce Britain's exports flows to Europe, because at the moment, a large part of their exports from the UK, gas exports from the UK to the EU, were motivated by the fact that their storage is full because their capacity is so low that they didn't know what to do with it, and they were earning decent money by selling it to Europe. They might not do that once Rough is back, and it will come back, because they now have new storage facilities to sell themselves, to fill them themselves. And so, and it will help for next winter, definitely, but for this winter, I think the British storage situation is pretty dire, sadly, because I live there.
So you're going to be, you may need a few jumpers there for the winter.
Yeah, and
winter
mittens.
Yeah. Henning, if we look at, you know, the sort of global LNG situation, who in a price war, who would win here, Europe or Asia in the winter if we did have this cold snap?
So both those sides, I mean, you can't really say the Asian is one side, because China, Japan, and South Korea do their own thing, but they both have a lot of money. And this is actually why I wanted to highlight South and Southeast Asia. They will lose out. There is almost certainly enough LNG to supply Europe and Northeast Asia, even through a cold winter. Barring, we heard this already, major outages, a hurricane in the Gulf of Mexico would be really annoying. But barring major outages, there's probably enough to meet Europe and Northeast Asia, but not enough to meet Europe, Northeast Asia, and emerging markets.
So there'll be some clear losers, which you've highlighted. Nathan Whitcop, question for you.
Yeah, I mean, just on that point, because that kind of wrecks the whole story that the LNG industry has been trying to sell for the last decade or so. Does this fundamentally kill the long-term prospects of the LNG industry in terms of changing it into something in which now it's like a base load supplier to Europe and, well, Japan and South Korea, and no longer the burgeoning source of cheap gas, cheap source of low emissions fuel for the whole world?
It's a good point. So, I mean, at the moment, if you are in an emerging market like Vietnam, Philippines, who are planning on starting LNG imports pretty much now, and you look at those prices and you think, no thanks. This is a total fiscal impossibility to invest into that infrastructure, then buy cargoes at that price, and then tell your utilities to sell electricity. It just won't work, and they will delay or cancel future plans. However, we have seen, I mentioned Pakistan before, so Pakistan National Oil Corp just a week ago announced it wants to spend another $500 million on a new LNG import terminal. And on first sight, you think they're bonkers. But, you know, they've been on the receiving end of not getting any LNG now, and even if they could, they can't afford it. But what they think is that because the high prices now, and the Europeans are basically financing the Qatar expansion and US shale expansion, that at the same time investing massively in demand destruction at home, that a deflationary cycle will start sort of mid-2020s. So if Qatari capacity is up, US capacity is up, and then suddenly the European gas consumption goes into strong reverse gear because in efficiencies and fuel switching and so forth, then suddenly gas might become very cheap. And that is what they're expressly banking on or hoping for. So it's a hope, though. I mean, I don't know whether that'll actually happen. But the reality is that virtually all LNG future import terminals in South and Southeast Asia are currently on hold or open for another window.
Henning, in the interest of time, no, there's a question at the back there, yep.
Good morning, Graham Whelan, Professor for Energy at the Royal University Bochum. 2 points. Firstly, in respect of all these LNG terminals which are being planned, is there not a risk of stranded assets, and what kind of operational lifetime are they going to have? If it's less than 20 years, then the unit throughput costs are going to be high. That's point one. Point two, something completely different. I have grave misgivings about this concept for 3 different markets, because then you've immediately got at least 2 problems. Where do you draw the lines between them, and what happens to the internal European market, given that countries have such different means of power supply and different full and variable costs? I can't see that working.
Yeah, both very good points, thanks. So on the first, there's a high risk of stranded assets. I mean, if all these LNG import terminals get built, and as I say, European gas demand will go into reverse now, the investment's already being made, then you're at high risk of having invested into something that won't be particularly attractive anymore come the 2030s. However, most of the current facilities are floating import vessels, like the one in Eemshaven that they finished it within 6 months, and the ones in Germany that probably will come over this winter. They're all floating facilities, and so they can be sort of shipped away fairly easily. It's the ones that are coming later, 24, 5, and 6, which the fixed import terminals, there's a risk there. I mean, I know that most of the developers are building them with an eye on conversion to liquid ammonia or liquid hydrogen imports at some point. But that's also, it's a big bet, and it adds further cost to the actual construction of the facility now. So it's something to be absolutely aware of. Not all the terminals that are being proposed will be built, and even some of those that will be built will be failures. I'm fairly certain there. On the part of the pricing, I think you're absolutely right. The other part is that I didn't mention there is, what do you do with the futures market? The futures market as we currently know it would not work under those conditions at all. So there's a lot of, and that's why I had to stress this is very early stage thinking, but that is the most common model that is currently circulating within the Commission. But there's huge resistance to it from some countries, especially, for instance, the Netherlands. Germany is also against it. But there's also quite strong support for it. So we expect something will give along the lines of separation of low-cost renewable markets from fossil fuel markets, because just the current pricing model doesn't work anymore. But how that will look in detail, well, we don't know. That was just a representation of just what's being discussed and floated at the moment.
Henning, I think we have to move the discussion on, but if you have any questions, please put them to Henning at lunch, and you'll be joining us on the boat cruise, of course. So there'll be plenty of time to put some of these, very thought-provoking ideas, to get more extended views on that. But thank you once again, Henning, for a very fascinating presentation.
Thank you.
And here's a little present from us. Yeah. Yeah. We'll if you can leave that on there, that's great. That's for Nathan. We'll change the format ever so slightly now, and we will move to a panel discussion. And leading the discussion is my colleague Nathan Wittkop, who's Germany correspondent for Montel News. And if I can just ask the other panelists to come up, so that's Gerald Auer from Compass Lexicon, Tobias Federico of Energy Brainpool, Andy Summer of Axpo, Paolo Cohi of Aquasmatics, and then I'll hand it over to you, Nathan. You're looking at the perfect storm, the drought, heat wave, French nuclear issues, amongst others. So over to you, Nathan.
Thank you, Richard. Yeah, so let me just briefly introduce everyone again, just so you're familiar with who we have on stage. We've got people with decades of experience between them in energy markets. Next to me here, Andy Sommer is head of fundamental analysis and modeling at Axpo. He's been with Switzerland's largest hydropower producer since 2008. He's got 3 decades of experience in energy markets. Next to him, we have Gerald Auer, a vice president with Compass Lexicon. He's got 17 years experience in energy market consulting and divides his time between Paris and Berlin. There we have next Paolo Cohi. He's president of Aquasmatics, 20 years in energy markets and commodities research. previously with the Brattle Group, the utility Centrica, Coke Supply and Trading, and as well as SocGen. And last but not least, of course, we have Tobias Federico, Managing Director of Energy Brainpool. He founded that company in 2003, and yeah, he counts the German government among some of his clients, and I'm sure he's rather busy right now. So I guess I wanted to start off this panel with a question to the same question to everybody, to get a feeling of where energy professionals see the situation that we're heading into this winter. Because I've had the impression for the last 6 months that much of the public and even the political class seems to have a very different view to how serious the situation is compared to the energy professionals I speak to on a daily basis. So yeah, perhaps starting with you, Andy, how confident are you we can avoid energy rationing this winter?
Not confident at all.
No.
As we heard today, do you guys hear me well? No?
Don't push the button.
Ah, yeah, I think you turned it off. Hang on one moment.
Oh, you hear me now?
Yeah.
Yeah, great. Okay. So my answer was, I'm not confident at all. As we heard rightly earlier today, it's so much about weather this year, and that is nothing that politicians can control. And we are so tight in all the markets, in coal, in gas, in carbon, in power, that only one hit from one or the other direction can put us over the cliff.
Yeah. Gerald, how about yourself? How do you see things?
Well, I think I probably share this view, especially from a French perspective. Like, so much depends on the winter and how cold it really gets. This can really push electricity demand and across Europe gas demand much beyond what like prudent or central scenarios currently cover, and it really could lead to situations that make it very difficult to handle. So, fully aligned at this point.
Paolo, do you have a more optimistic take?
Unfortunately not. So it's more like, where will the crisis hit most, right? And so once again, one of my old friends used to say, hope is not a strategy. So we're in a situation here where we're hoping not to have a cold winter. And then in the detail, of course, is you know, if it is a cold winter, will it be cold everywhere? You know, like for example, 2012, that would create problems. And then where would the rationing actually happen? Would it happen in the sort of at the residential? Would it happen at the electricity production? Would it happen at the industrial level, right? And there are clearly, especially if you look from the political side, there's some priorities there as to where, if you could pilot the rationing, right?
Yeah. Tobias, you've got a sunny disposition, so please lift my mood.
No, I think we have to differentiate a bit between natural gas and power. I think in the gas market, the likelihood of rationing and shortening has decreased. It depends on the winter, definitely, but I think the situation in the power market is a bit more tight, and there depends on the winter and on France mostly. So, yeah, if we are lucky, we are going to manage it, but luck is not a strategy at all. So.
Okay. Well, I mean, I've got a professional here next to me whose job it is to crunch the numbers. So, Andy, maybe you can give us a bit of detail here. How much gas are we missing in the system, and how much are we likely to be able to close this winter? Can you illustrate for us the size of the gaps we're facing in terms of gas and power?
In terms of gas, it's more tricky than in terms of power, actually, because gas is that global world, is that LNG pretty much everywhere, and it's interconnected with the coal side of things as well, as we heard correctly as well. So when we have a cold weather period or a wet weather period in the coal supplier areas, which happen to be oftentimes also a gas producer, LNG producer, having the same issues, then of course the deficit, the downside in gas would be significantly different than when we would only have a bit of a cold extended period here in Europe. So that is really depending on quite a lot of global developments. On the power side, I guess it's more localized around Europe, around center of Europe, but the gas is really, I think, a global issue. And with that less easy to quantify.
Yeah, I mean, political leaders have in recent weeks expressed quiet optimism because of the state of the storage we managed to refill this year, but we've heard speakers already express the opposite sentiment, that despite full storage capacity, they're still worried about the coming winter. This year we still had Russian volumes that helped us refill our storage. So come next year, will we be in a better situation or in fact worse?
I think it again starts, of course, on the starting point after this winter. But generally speaking, assuming we have a normal kind of winter demand supply pattern, and we start on a fairly okayish level of gas storages after the winter, we do, you're correct, have a big problem. Europe imported about 55 BCM or something like that from Russia this year still. Europe imported a lot of coal still from Russia this year. And all that has to be replaced next year. And is that possible just by more renewables, more, hopefully, French nuclear? We can put a question mark on that one. It depends on many, many, many things this time around.
Yeah. Gerald, I saw a figure earlier that I think it was from the Enovus presentation that I believe French generation is down, nuclear generation down about 30%. So in terms of terawatt hours that we're talking about here, and in terms of the implied gas that needs to be filled into this hole, how much are we down in terms of electricity, and what are the prospects for getting that back in the coming months?
Well, maybe there are a few things to distinguish. First, French nuclear generation at the moment is at basically an all-time low, so that's like something we've not seen in the last 12 years.
I'll just get your microphone a bit closer if you don't mind. Thank you.
So basically, French nuclear generation is at an almost all-time low at the moment. Like in September, there were like 25 gigawatts, I think. But the reason for this are twofold. So on the one hand, there are like regularly planned maintenance operations ongoing, which are starting to be finished, and we've already seen some plants going back online. So that's about overall like 17 to 18 gigawatts that are in like regular scheduled maintenance and decennial overhaul. That's going to be coming back over time and adding to the available capacities. And the other part, and that's the bigger issue and also the bigger source of uncertainty, are the corrosion issues that were identified so far. And that's, again, about 18 gigawatts of generation that is currently unavailable, partly due to actually detected corrosion, so that they will be offline for some time and are under repair. And it's basically a question of how long these repair works do take, and that's a fundamentally technical question, how long it takes and how quick resources can be mobilized to get those capacities back online. And then there's another big chunk of capacity, about 13 gigawatts, that are currently under inspection for corrosion. So this is the same type of plants where corrosion was detected so far. So they're under investigation, they're shut down and undergoing investigation. And the big uncertainty here is whether or not there will be corrosion to be found and how long repair would take. So to pull this together, basically the current expectation is that by the start of the winter there should be about 40 gigs of French generation capacity back online, based on the latest assumption from the latest notification by EDF and assumption by the French TSO. This should increase later on during the winter, but there is still some uncertainty how far this could increase, and that depends fundamentally on those corrosion issues that are under investigation. That's like a purely technical issue at the moment.
Paolo, before we started the conference, you mentioned to me the French TSO's forecasts for the coming winter. You made an interesting point about it coming somewhat earlier and them giving the all clear for autumn. I wonder if you could elaborate on that. What is so significant about the French TSO's forecast, and did it give us the all clear for the coming winter?
Okay, so yes, so the transmission system operator regularly does updates on what the status of the market is going to be, and of course the mostly watched one is the one about the winter, since French demand in particular is very sensitive to weather. One departure with respect to the past is that this year's winter assessment actually included autumn and winter, so that already tells you something. In any ways, they did have something positive to say. Autumn is going to be okay. It does chime well with good weather forecasts. Of course, you know, these weather forecasts for autumn are reliable since it's very nearby, but they did not give the all clear in terms of what might happen in winter. And as a matter of fact, and as you can expect, there are no tiers to the fabric of sort of reassuring the market, right? So nothing really dramatic is expected. However, right, that's always the however, they expect that things can get tight or very tight or very, very tight depending on the scenarios. Now, of course, the probability of the very, very, very tight scenario is extremely low because it is a summation of different risks, right? So if we have a cold spell, if the cold spell is, you know, occurs in more than just locally in France, if the nukes don't come back, and so on and so forth. Having said that, they do spell out a scenario in which you can look at interruptions for 20 to 30 days, tops, okay? Then, of course, they spell out that these interruptions would be managed. They spell out that the interruptions would not occur at weekends. If you're in the industry, that's obvious, right? That it will occur at peak times. Now, again, that's obvious if you're in the industry, but you also know that that correlates with prices. So then again, if you've got a commercial mindset, that's a signal for you. To summarize, no, the RTE does not give the all clear. There is hope still, but it's contingent on a variety of things going the right way, not least of which being the weather.
Tobias, what about Germany? What are the expectations here for the coming winter? In the past, the south has been identified as the area of most concern, and it's increased its dependence on its neighbors, and France is one of the neighbors that it's dependent upon. So is Germany here likely to be the place, southern Germany, where we see a crack emerge?
Well, southern Germany has an issue because, first of all, they're not so connected to the main rivers itself, and secondly, that's why they didn't have coal power plants and they had nuclear power plants. Phasing them down and replacing them by, at least this was the plan, gas power plants could increase not only the total production capacity, but also the grid stability. And if a crack starts, it starts with the grid instability there, and which is then the redispatching measures. And if you look into the scenarios and analysis from the transmission system operators, they really look into the whole capacity at all. They looked into the situation in France, and they have also looked into electrical heating, because there was a boom for most of the Germans in fear of having cold rooms because we have a gas shortage, to buy electric heaters, which is new for Germany, which is common in France, for example, but it's completely new for Germany. So they've integrated that. But the topic was, especially in southern Germany, there might be an issue under certain circumstances that for the redispatching measures, there is more power needed to redispatch the grid, to look into the grid stability, because we have a north-south or northeast-southwest issue regarding the German grid.
There's been a lot of pressure on Germany to simply give up on its nuclear phase-out, at least for the time being. What's your view here? What's stopping Germany from simply just letting these reactors run?
Well, in Germany you have to face it's a Pandora's box because you're opening an issue you thought you have closed. The thing is, running a nuclear power plant a little bit longer might help a little bit in substituting natural gas, but it's only 1% of the total demand. And the main reason is most of the natural gas power plants are running on CHP basis, which means that they're producing heat, and nuclear power plants are not producing heat. So that's the topic. The second thing the second argument was on the wholesale prices. The wholesale price effect, if you take the merit order model, and you simulate that, you see that the effect are marginal. It's €5 per megawatt hours. It used to be quite a lot when we had 20 euro per megawatt hours in electricity markets, but at 500 euro price level, it's really marginal. And the second main reason, and that's the political argument right now, is that we have this redispatch situation. And that's really interesting because we know since 10 years that we are shutting down a nuclear power plant there, and we might have a redispatch situation there. And suddenly it pops up and says, oh, we have a redispatch situation, and that's why we need a nuclear power plant. For me personally, it's a little bit difficult because first, we don't have the fuels, so we must either buy the fuel from Russia for the nuclear power plants, or we must reduce production right now to extend the production. And secondly, there is a safety issue. And third, I think we are wasting a lot of energy in this political discussion instead of looking for solutions for the storm which is coming up.
I think another thing that's overlooked in coverage of Germany, at least in the mainstream press, is often electricity is conflated with energy. And of course, electricity is energy, but energy isn't electricity. And a lot of that gas demand in Germany, it's not necessarily going to power, is it? So what are the prospects here for rapidly phasing out, or at least reducing, German gas demand?
Well, actually, power is only responsible for 10% of the natural gas demand in Germany. The biggest part is heating gas, and this is mostly in the household sector. And secondly, of course, then in industrial production. In industrial production, unfortunately, or luckily, it depends a little bit, we see a situation where the gas demand decreases quite a lot. First, due to the prices, so there is an efficiency increase somewhere, or you make a fuel switching. But secondly, also, there's a situation where sometimes industrials really don't know what to do at high prices. So they shut down or reduce their production. Some of them also optimize themselves. So they shut down the production and sell the gas to the market and earn more by producing their standard goods. We also see this situation. But the biggest impact we might have in heating gas in the household sector, unfortunately, the government can't do anything there. But what is the bad thing is that we see in Germany reducing gas demand is showing us that we missed the turnaround in the heat sector. We are speaking about Energiewende in total in the electricity market. We are speaking about Verkehrswende in the mobility sector to make this turnaround. And we said, yeah, well, there will be the heat turnaround someday. But we see now we missed that, and that would have been great having right now.
Yeah. Maybe we can turn. There are a few things I'd like to fit in the next 10 minutes before opening the floor to taking questions from the audience. But maybe we can turn briefly to your interpretations of the EU emergency measures and the national measures to address the crisis. As I can tell, there are 4 broad steps governments want to take, and that's one, to tap into the, to cap the remuneration of market participants that are not gas-fired or coal-fired generators, to try and recoup some of that money and turn it back to, return it to consumers. There's efforts to rein in demand. As far as I can tell, it's mostly voluntary measures that have been agreed among member states. I don't think they've been able to agree to mandatory measures so far. There's the issue of a price cap on importing gas, whether from Russia or more broadly, and then there's the issue of liquidity support. These are the 4 areas that the EU hopes to solve the gas crisis with. How do you, Andy, interpret this response? Is this sufficient? What are your concerns about the measures outlaid so far?
If they are sufficient, we will learn, hopefully, in the next few weeks. What we know and what we've seen on the table right now, that written document of proposal still keeps a lot of questions open. For example, whom exactly is that 180 euro megawatt hour cap applying to? We have in Germany high efficiency coal plants that right now are below that 180. We have the low efficient and mid efficient plants that are above that cap line. So will they do it then by technology, or will really that kind of cost measure be the trigger point? And if so, how to measure that? That can create kind of optimization consequences that are unattended, that suddenly a very efficient power plant claims it's less efficient. Even harder is the situation if you look over there to Poland. The Polish don't fire their plants with API 2 high prices. So their hard coal plants are running below that 180 cap all the way through. And no one right now knows how they are going to be handled in the future. So there's a lot already on that first point you mentioned, a lot of uncertainty right now that also prevents actors to do something right now. So there's quite a bit of standstill. I have the feeling also talking with our colleagues across Europe, because many people don't really know what is actually going to happen and how is all that going to be implemented at the end of the day.
Yeah. Tobias, in terms of the revenue cap, I believe you have some concerns about that and the implications for trading. Maybe you can elaborate. What's the problem here?
Well, some concern is really polite. I think I'm very concerned. The main reason is when you read that paper, what's on the table, I ask myself, well, it only works if the market works completely with the merit order model, and every trade is physical and only traded once. We had the discussion before, what's about the future market and forward market. The problem is really that the electricity is very homogeneous, and that's why the market is working very well. And we have the spot market, we have the intraday market, we have the forward market, or the derivative market with the forwards and the financial future contracts. And when you start that the value of the electricity, the worth of the electricity depends on the type of asset you are having, and you sell on the forward market, what asset is going to produce there? Or let's take the example of a renewable producer. I'm, as a renewable producer, selling my electricity at 180 to RWE, let's mention this name, and they have CCGT power plants. And they take the same electricity, structure it a little bit, and then sell it for 600. Why? It's the same product, it's the same commodity, and this is one problem. The second problem is we had a discussion before which was quite interesting regarding speculators. Speculators are there and they are necessary to provide liquidity. I can't, with this measurement, I can't get short. Because if I don't have an asset, I can't sell out of my asset without having assets somehow. If I can't get short, the market will dry out, and in the end he will be dead. And that's my biggest concern. So the whole system only works if we have a mandatory spot market and we have guarantees of origin for every producer.
Okay. Yeah. I see that I'm actually running very close now to our lunch break, so if it's all right, I'll ask the floor if there are any questions that you would like to address. I'll gather 3 questions perhaps, and we'll put them to the panel. And if not, then I would put in maybe a final question of my own to each panelist. But there are no questions. Then, yes?
Thanks a lot for the nice discussion. My feeling is more and more I'm feeling like we're really all lost in some big dust. And I mean, we all have all these different scenarios, speculations, and how this is going to happen and so on. But just to ask you, maybe to Tobias, directly to you, what is really the worst case scenario you see in terms of the intervention? I'm not talking about even the fundamentals anymore. And what is really your optimistic scenario, the most optimistic, in just 2 quick sentences? Thank you.
Well, the worst scenario of intervention is that we are capping prices in all markets, yeah, somehow, because and the worst scenario is we do that and rewind all the historical traded contracts, because even that is not clear. And this will be the second perfect storm. We are in the middle of the storm of the fundamentals, and there comes the second regulatory storm. The best scenario is that the German system operator for gas is buying gas, whatever it takes, to fill up the gas storage. We might fill it up within the next 10 days. After that, there will be no pressure on the gas market. So gas market will decrease and the prices will decrease to, let's say, normal level for the situation. I would guess it's 120 euro per megawatt hour. Then electricity prices will drop to 200, 250 euro per megawatt hour electricity. And then the politician says, well, maybe we don't need to make an intervention or a slight intervention. This is the best case scenario.
All right, then on that note, I'll hand back to Richard and we'll wrap this up and head off to lunch. Thank you very much, everybody, for taking part in the conversation.
I hope you all enjoyed lunch. Again, it's quite nice to be away from the screens and a different world where we can all meet physically and discuss important issues over coffee, over food, over some refreshments. We've talked before lunch about locking in LNG. We talked about gas, coal. But this afternoon, we're going to move a little away from fossil fuels. We're going to go into renewables, what's happening in Germany, and then talk about PPAs, as well as focusing on, very, very importantly, the view from industry. I think, Tekla, you have maybe one of the most difficult presentations, the one straight after lunch, but I'm sure you do brilliantly. So you'll be talking to us about Germany's renewables and hydrogen expansion. So, Tekla, it's great to have you here. The floor is yours.
Thank you very much. No, it's an absolute pleasure being here. So my name is Tekla von Bülow. I'm heading our consulting business from Aurora in Berlin. For those who don't know Aurora, so we are an energy market modeling and consulting company. So we focus our business on forecasting or trying to forecast as best as we can the electricity and commodity prices. Today I have the pleasure, as Richard was saying, to talk about the future ambitions and looking back at actually the main topic before the start of the Ukraine war, which was really how do we get the energy transition going. This is a topic that obviously in the current market situation has become more important than ever, both ramping up renewables and hydrogen in order to have a positive substitution effect to our gas consumption. So just to set the scene a little bit, and I know we've seen it a couple of times already today, but I think it's still important. As a scene setter, we do live in really unprecedented times. The power and the gas prices have really surged enormously in the last couple of months, especially since the start of the invasion in Ukraine. The gas prices especially were spiking in recent months and weeks since the massive reduction of gas from Russia, especially since the volumes went down in Nord Stream 1. But what we can see also from the graph is that actually the impact on the power prices are much more substantial. Gas being the main driver for this, certainly, as gas is setting the price in a lot of hours, and so with higher fuel cost also the power prices go up. But there have been a lot of other effects that have contributed to very high power prices, such as a reduction in nuclear availability in France, but also historically low level of hydro across Europe due to very dry winter, as well as very high coal prices, which on the one hand were also driven by the reductions in provision from Russia, but also transportation through the Rhine, for instance, was very difficult in the last couple of months during the summer because the water levels of the Rhine were so low. So this is really the scene setter, but what we want to discuss today, or what I would quickly like to discuss today, are three things. On the one hand, reminding you of what the targets for Germany are in terms of both renewables and hydrogen, the main topic being, is it a realistic target, or are we living in a dreamland in terms of both of these targets? Which we will tackle in the second part here, on the renewable targets being realistic, and what is also the impact on renewable investments from the current crisis. And thirdly, are actually the ambitions for hydrogen, so especially green hydrogen in Germany, realistic, and where do we stand in this respect? So again, kind of really big picture, where do we stand? So the main ambition, obviously, is to get Germany to net zero by 2045. The ambition is to reduce the CO2 emissions by 65% until 2030 compared to 1990 levels. The ambitions have further increased since a Supreme Court ruling saying that the current climate ambitions are not specific enough and not ambition enough, especially. And these targets are breaking down for different sectors and also for the different years. And what I think can be very clearly said here is that the power sector needs to play the major contributing factor to reducing emissions. So a decrease of 77% compared to 1990 level emissions for 2030 in order to be on track for a reduction in 2045. So even though these climate ambitions have been set, we don't expect more ambitious climate targets from the current government. However, it still needs to be much more detailed in terms of monitoring, reporting, but also concrete measures on how to accelerate all the measures for the different sectors to actually be able to achieve these emission reductions. In terms of targets then for the renewables specifically, but also for hydrogen, so on the renewable side, it's actually quite an impressive increase that we're targeting until 2030, so an increase by over 170%. You can see here that especially it is very ambitious in terms of the build-out that is required on the solar PV side. On the electrolyzer side, there is a current target of the government of 10 gigawatt, which already is double the amount that the previous government had said of 5 gigawatts. It's important to mention also that the resource, or not the resource, the REPower EU program from a couple of months ago put another target on the table, not a very German-specific one, of aiming for 10 million tons of domestically produced hydrogen by 2030. So that is around 150 gigawatts of produced hydrogen for all of Europe. Germany will have to play a substantial role given the amount of industry demand in the hydrogen space. So if you look at the EU targets, then probably the German government target is still fairly conservative compared to what the EU is aiming in that respect. Now, in how far are these targets realistic? And starting off with the renewables here. So Aurora, as I said, is an energy market modeling company. We have different scenarios that we work with, and the two main scenarios that we work with is what we call the Aurora Central and the Aurora Net Zero scenario. The Aurora Central is basically our best guess on how the energy markets will develop based on the current frameworks and on the activities that we expect from market participants, the investment cases for different production types, and so is kind of a market-driven scenario, whereas the net zero scenario, as the name already says, is actually a target scenario. So with the net zero scenario, we answer the question, what needs to happen in order for net zero to be achieved in 2045. And what we can see here on the right-hand side is actually that when we both look at the central scenario and the net zero scenario, both scenarios don't reach the government targets for 2030. So even the net zero scenario doesn't reach the targets. Even it needs to catch up, let's say, until 2045 to reach the government targets. But this interim target in 2030, we don't believe will even in the net zero be able to be achieved. What is also impressive, or makes it quite visual, I think, on the left-hand side here of the graph, is what kind of annual build-out rates will be required for the different technologies in order to get there. So on the bottom of the three bars, so on the top solar, then onshore wind, offshore wind, you can see the historical build-out rates, the gray bar showing the maximum build-out rate annually that was ever achieved for those technologies, and then we compare that to our central and net zero scenario. So especially impressive, I find the solar build-out that is required in order to get on the net zero track, which would require 4.2 times the amount of historical build-out that we have seen. We really see a lot of hurdles in terms of the build-out of renewables. A very common one that is discussed a lot is around the permitting processes and getting the consent on local levels, which is really important both for solar and especially onshore wind, slowing down the processes. But there's other aspects also that come into play and that are not negligible. For instance, the grid build-out and expansion that is required in Germany in order to incorporate all of the renewables, as well as a lack of skilled workforce, and especially relevant in the current moment is issues really in the supply chain of the technologies required to build out the renewables. So in terms of what is required versus what we're currently seeing, certainly there's a lot higher ambition required in order to get us on track in terms of the renewables. The other really important aspect that is often discussed with the market players is really what is the investment case for renewables? Will we see a build out on a subsidized level, or will we see more renewables being built out on a merchant level, so without any subsidies? And the main thing that renewable investors are looking at is what kind of power prices can I expect when I'm selling my power to the market versus what are actually my costs for the renewable project. And the cost is something that we translate into the KPI called the LCOE. You will be aware of it, so the levelized cost of electricity. And here we compare it to the renewable capture prices, so the generation weighted prices that renewables can generate on the market depending on their production portfolio. And that is shown here on the top for solar and on the bottom for offshore wind. And what becomes quite apparent is that especially for solar and especially in the net zero scenario, already in 2030, the capture prices will be below LCOE, meaning that without help of subsidy schemes, it will be very difficult just to go to the wholesale market, sell the power on the wholesale market and yield enough revenues to cover the costs of the project, which is something that is quite concerning, and something that in the current situation with the very high prices might not be on you know, the front page of discussions, I would say. The main reasons for these capture prices to crumble is because of the fact that when wind and solar is available, so that renewable assets are producing, in those hours all of the renewable assets are producing at the same time, really pushing the price very low in the merit order. So there's a lot of renewables coming in on the left side of the merit order, so that the prices in those hours are very low. So this cannibalization effect, as we call it, is really the main source of these crumbling capture prices. So, as I said, we'll have to think about subsidies again, as well as how to optimize the hours where electricity is sold. So flexibility solutions will certainly be helpful to offset some of these effects. Now, when we come to the current market situation, and we've talked about it in the morning already, there's quite substantial announcements on energy markets as a response to the very high prices, and a proposal by the EU Commission in the last week. The current idea on EU level, at least, is to implement a price cap on the power markets of 180 euros per megawatt hour, which would mean that all inframarginal technologies, including renewables, so inframarginal meaning all technologies being within that cap in terms of their marginal costs and bids in the wholesale market, will have to hand over the surplus revenues that go beyond 180 euros per megawatt hour. And this is a proposition on EU level. It's not at all clear yet how it will be translated into the German system. The current idea of Germany is to go even further. So instead of having 180 euros per megawatt hour cap, it will be a technology-specific cap, so that this yellow area will go much further down, so in a stepwise way to cover the payback of the individual technologies. Lots of questions that are still open around the proposition, especially how it will be implemented in Germany. The major one being, of course, how do you set a cap that is incentivizing market participants to still participate in a market environment, so not to distort in any way the merit order. There's also lots of questions around how PPAs, for instance, will be affected, as well as renewable projects coming forward. So even if a lot of market participants have asked for it, new projects that will come online will not be exempt from this rule, which in effect increases evidently the market uncertainty of a lot of renewable investors, which again will not accelerate or not help to accelerate the build out of renewables. So a lot to be seen, a lot to be discussed. We've had great discussions around it already over lunch, and I'm sure we'll have further discussions around this during the afternoon. Coming to the big topic of hydrogen, so hydrogen being much more in the spotlight now, also as a substitute for gas in the industry sector, and really being the most kind of forward-thinking technology in Germany. Also lots of questions still open around the ramp-up of hydrogen, and especially, obviously, the domestic hydrogen development of electrolyzers. So as I said, the government target is around 10 gigawatts. The good news currently, finally bringing some good news to the room, is that there's around 21 gigawatts of electrolyzers in the pipeline in Germany. even though kind of the current operational electrolyzers the numbers is very low. So it's actually not zero exactly, but it's around 80 megawatts, but it's certainly still a lot of projects in an early stage area. The location of the different projects that we're seeing here on the map, we can see that there's a lot of projects in the north west of Germany, also coinciding with the availability of renewables. So a lot of projects are near, on the one hand, industry clusters, but at the other hand also the location for renewables. There's also the main question whether all these projects can come to life. One major hurdle in the last couple of months was certainly the regulation from the EU level again on the quality of the green power for the electrolyzers. So the so-called RED II regulation. Since last week, we have heard some news from the EU again, working on the RED III regulation, that the hydrogen requirements or the green power requirements for the production of green hydrogen might loosen again, which could help again accelerating the development of these projects. So these are the pipeline for the green hydrogen. But when we look at the actual demand that will be required for hydrogen, the picture already looks a bit different. So hydrogen will play a major role in the decarbonization of Germany. Again, here we differentiate between the central scenario and the net zero scenario. And as you can see for the 2050 numbers, the net zero scenario is much more ambitious. And the main driver or the main difference between the net zero and the central scenario is that with net zero, you have all of these very hard to abate sectors that need to decarbonize via hydrogen. So there's a lot more demand from industry for carbon neutral hydrogen, but as well in the power sector. And so in the power sector, hydrogen in a net zero world will play a crucial role in covering for those peak hours where there's very high demand and very low renewable production. So hydrogen will be needed as a peaking technology, a very flexible technology in the power sector to ensure that the capacity in the market matches the demand. What we can also see, again, when we see the government targets now for 2030, there haven't been targets for the later years, that actually the German targets are quite unambitious compared to what actually the demand will be for hydrogen. So the question is, effectively, can we cover all the hydrogen demand domestically? Answer being no. Germany will be quite dependent on hydrogen imports. Around 2/3 of the hydrogen demand will need to be covered by hydrogen imports. And so the main challenge is to get these imports or the import infrastructure in place in time in order to be able to fulfill these demands. So investments into pipelines, but also into ship infrastructure, especially transport via ammonia will need to be developed in order to get those volumes there. When we look at the LCOH, so it's a very similar concept to LCOE. So LCOH is the levelized cost of hydrogen, and compare that kind of the domestic production in orange versus what imports would cost for the moment. So for the moment, the production of hydrogen, green hydrogen domestically is still cheaper. The main reason is that there is no infrastructure in place. So for instance, imports from the Nordics and from Spain need to be transported via trucks, which is incredibly expensive. And so we expect the hydrogen market really to develop domestically at first, to then, once the import capacities and infrastructure is in place, then to be really replaced by really a commodity trade of hydrogen, and the imports being the price-setting one. So we'll expect imports from areas that are much further away, such as Australia, also Canada. In the end, once the ship infrastructure is in place, it doesn't really matter where the volumes are coming from. The price difference, once it's on a ship, is actually not that substantial. So we expect kind of this international trade to develop around 2035. So coming to an end of the discussions, key takeaways, whether all of this is a dreamland or whether we can reach those targets. In the Aurora view, especially the central view, the renewable targets are not met. Even in our net zero scenario, the 2030 targets for renewables are not met, and especially concerning is the decrease of the renewable capture prices below the levelized cost of electricity, which need to be addressed in order to make investment in renewables further attractive. The crisis obviously having a major effect on the current market situation, meaning that it's certainly not accelerating or helping to accelerate the renewable expansion, with a lot of uncertainties of renewable investors currently in the market. In terms of domestic electrolyzer targets, these are achievable when we look at the pipeline. However, the main point is whether we can achieve and actually realize all the projects that are in the pipeline, and especially when we compare it to the actual demand, then there is much more ambition to be had in the space of hydrogen, and especially making sure that the imports are being ramped up. That's it from my side. Thanks a lot.
Thank you.
Do you have?
Excellent, Tekla. Thank you for that overview of government targets and also what you think at Aurora. If I can just, there are some questions around these emergency market interventions, of course, and some of the proposals also mean looking at the marginal pricing model, the merit order model. If that were to be changed, would that change the investment? Would that also then transform the investment case for renewables in the area where you think there'll be too much cannibalization? Would that have an effect there?
Yeah, so again, it really depends on where the caps are being set. So if you look at the 180 euro per megawatt cap, this is still much higher than what the renewable projects would have anticipated, a year or two ago. So in Germany, really the main question is where the technology-specific cap is set. The other question, obviously, is how long will these measures actually be in place? So for the moment, the plan is for these measures only to be implemented until the end of March, which is obviously a very short time frame for the amount of market intervention and also implementation questions that are coming up. So that also needs to be seen. But for the moment, it is quite concerning, not only for the renewable investors, frankly, but also required investments into gas infrastructure, for instance, that Germany is banking on is currently completely on hold because of the market uncertainties.
And it's interesting that you say, we're in an environment where there's a lot more merchant renewables coming online that's not dependent on subsidies, but yet you say by the by towards 2030, we are going to be reliant on subsidies again to get this online. Yeah, that's very interesting. The other thing that always puzzles me in the hydrogen equation, if we turn to hydrogen, is, I don't quite see the economics here. You produce renewable energy, then produces hydrogen, you then ship it, you transport it either through pipes or through ships, and then you burn it to produce electricity. I don't see how that, in certainly the current environment or in the next 15, 20 years, makes any economic sense. Because why not just use the renewable electricity to start with? Or build out rather,
Yeah, so fully understand, and especially kind of the hydrogen ramp up will not be focus in the first years to be used in the power sector. You really need the hydrogen to decarbonize the industry and also substitute where grey hydrogen is already being used, such as in refineries, in the production of ethanol, and so on. It is only in the later years that hydrogen will play a certain role in the power sector as a flexible power source. And again, here we see a massive difference in the usage between the net zero scenario and the central scenario. But indeed, in order for all of it to make sense, it probably needs support in the first couple of years. It very surprisingly, for instance, in the new EEG 2023, in the last second, really, there was an introduction of auctions for hydrogen power plants. So there's no real detail around it yet, but it's quite surprising that Germany is trying to expand renewables so substantially, but at the same time is already auctioning support for hydrogen power plants. So we will be looking forward to see how the developments and the plans for Germany around this will be. Primary usage for industry, and there is some willingness to pay for certain, but the hydrogen prices are certainly too high, especially since green hydrogen needs PPAs, and the power prices are extremely high for the moment. Yeah.
Any questions from the floor at the back?
Graham Wheel from the Ruhr University. Thank you very much, Tekla. That was a very good presentation. I agree with everything you said, but I think you missed out an important element, which is the following, and that is the increasingly fragile position of the German industry in total. If we start with renewables, the 5 main manufacturers are all losing money at the moment. So it's anything other than realistic that they are going to be able to ramp up their production capacity anytime soon. So that's yet a further obstacle that speaks against realizing the renewables targets. The second point is energy in total. I learned from my students recently a new expression, green leakage, meaning the green products that are needed in Germany or other countries may very likely be produced quite outside Europe. We've already got the example I give you is Daimler contracting green steel from Sweden, not from Germany. Then for hydrogen to work, one area that, in my view, has been completely neglected is what kind of supply contracts are there going to be. My experience as an energy consultant was with natural gas. I think there are very interesting parallels and differences that can be drawn. The two critical questions are, what will the price indexation of hydrogen contracts be based on? Yeah. And the second is, what will the auf Deutsch Bonität, so the financial standing of the industrial customers be? And looking at those, how many producers of hydrogen will really have the courage to sign long-term contracts with them? So, in a nutshell, I see some very serious problems which unfortunately are not being discussed at all, but need to be brought out into the open. Comments, please.
Well, thank you, Graham. I only had 20 minutes, otherwise I would have brought in all of these aspects as well. No, yeah, fully agree on everything you said, as usual. So the main points for hydrogen and industry is certainly that the industry will need some kind of support to be able to ramp up hydrogen. The industry representatives, I think, will speak after me, so there's probably a lot of input that they can also give on that topic. So the questions around carbon contract for difference will be really important in order to give the industry some incentive actually to switch to green hydrogen. Elsewise, indeed, there's some very valid concern for the industry to move elsewhere, not only for hydrogen but also for the general energy prices. In terms of how the price setting will be, there's also lots of questions, obviously. I just showed the ACOH, which is really just cost-based. But there is no real reason to assume why the imports would be priced on the basis of ACOH, right? If you compare, for instance, the prices that we're paying for oil, we are not paying the marginal cost for oil. We are paying a substantial on-top margin on the prices as well. So these are really big questions in terms of how will the prices evolve. In the first stage, in order to really be able to make investments into hydrogen, the biggest bottleneck, especially in hydrogen infrastructure, is to get the demand side to sign up. So it really is kind of a chicken and egg for the moment. If you build a pipeline, you have to secure the demand, but if there's no pipeline, the demand will not sign up. And that is basically also linked to what will the price be, what will the volumes be, when can I plan with it. So there's lots of questions open here and to be solved with long-term PPAs, for instance, and long-term contracts on hydrogen. On the power side, you could have some certainties on the prices, but that's really kind of for the one-to-one producer off-taker relationships, but not for kind of the large-scale ramp-up of the hydrogen market.
Tekla, thank you. In the interest of time, we have to sort of move on, but I think it's an absolutely fascinating topic, or both of the renewables expansion and the hydrogen. So I'm sure there'll be plenty of questions when we get onto the boats and possibly in the break as well. So here's a little present from us, Tekla. Thank you very much.
Thank you.
Thank you.
Come on.
Thank you. Moving on to a related topic, we're going to touch upon PPAs in Germany. And how to, oh, there you are, Jan.
Sorry, yeah. Sneak back on you.
Yeah. Perfect, Jan. And so to talk us through how to manage the risks involved in PPAs on both sides of the deal, probably, will be Jan Gibbert from Centrica Energy Trading. A warm welcome to you, Jan. And let me just try and find your presentation.
Perfect. Yeah, good afternoon, everyone. It's also for me, of course, a real pleasure to be here today. First of all, thanks to the Montel team for the invitation. It's great to be here, and also for the many interesting presentations from the previous speakers that I've already heard. I think we can summarize it quite gloomy morning, unfortunately. I cannot promise that I'm able to fully balance it out, but there are some positive aspects in my presentation as well. So we can take it from here. And I think we're also not just discussing it here, of course, right? The kind of gloomy picture in the markets, but just as an industry as a whole over the last couple of months. And so it's really difficult, of course, to remove yourself from that discussion. And so we really wanted to take the opportunity here today to also present our view on the situation and the impact it can have on PPAs for the German market. I don't want to spend too much time on introducing the company, right? But in a nutshell, we are a utility energy trader. We are operating out of London and Aalborg. I think core is that besides trading electricity, gas, and LNG, we also have roughly 16 gigawatts of assets under management, of which 85% is renewables. So we do have some expertise in this topic. Yeah, as I mentioned, I mean, not only in our industry there is a lively debate, we also have a lively debate in the public sphere. I've picked up a couple of articles which I thought were quite striking. Besides, of course, the general topic on energy scarcity, there is or has been a lot of discussion around collateral and cash requirements, as well as also the EU emergency interventions. And if you think about it, this is actually very unusual, right? For anything energy market related to be on the headlines of kind of newspapers such as The Guardian. And that, I think, just underlines the magnitude of the situation that we are in. And while this is an important debate, usually these articles are not written from the perspective of a utility or renewable energy traders. So that's really what we want to add here at this point. And we'll do this by looking a little bit at the current market turmoil and the PPA opportunities that we're seeing. And then, of course, also that elevated prices, as we have experienced over the last 12 months, are also creating elevated risk levels. So that is the more gloomy part. And then I also want to round it up by just looking a bit at PPA growth outlook, like what do we see in the German market? What are the hopes of kind of companies like ours for the development in Germany? And if we start the presentation, I think the graph has been shown, I think the third time if I got it right. We basically just want to keep a quick look here at the calendar year 23 baseload contract of Germany. Yeah, the blue line is the baseload contract over the last 12 months, and basically the development that we have seen. The green line is the capture rate, right, that has also been discussed from an average German wind onshore profile, and that's around 80%, yeah, like give or take. And then in yellow, the horizontal yellow line, we wanted to create kind of an average feed-in tariff that these assets usually have. That's roughly 93 euros. We kind of averaged it over 10 years. I mean, don't quote me on these numbers specifically. It's just more a point of illustration than to create an like a fact. And I think what's really interesting, of course, and what has happened over the last kind of 12 months is the fact that anything above the feed-in tariff and basically below the green line, the capture rate, is a potential opportunity for a German asset developer. Specifically because Germany is not operating, of course, under the contract for difference system from a subsidy point of view, but it is operating basically with a feed-in tariff that is giving them a floor price with the potential to, of course, capture all the additional income above. And there were, based on this graph, over the last 12 months, quite a lot of opportunities for asset developers in this space to use the kind of forward prices that you could see on the calendar year 23, but also 24 and 25, to lock some of these prices in and to conclude fixed prices. And that is an extremely new dynamic, right, for Germany. This has never existed before, so we've seen a lot of activity, I think, across the industry with asset developers having demand for these kind of products. We're speaking physical contracts, financial contracts, right? So it's really kind of opening up the debate in Germany, and there are various elements as well regarding balancing risks, etc. But so I think this has been quite a positive impulse, actually, on the German PPA market. And if we look at the kind of long-term development, and then again starting with the graph here, and I think I've seen this graph earlier before as well, it is the backwardation on the German forward curve that we can see kind of developing over the next 10 years or so. And the backwardation is, of course, pretty much driven by calendar year 23, which is quite obvious. And then, but you can still see that calendar year 24, 25, 26, 27, the backwardation still exists, right? So it's something that you can expect to continue, at least in the medium term. And I think the second important aspect to mention here is the very high average baseload price. So that's roughly 200 euros that we currently see. The prices are from last week, so they might have changed, but I think you get the message. And we believe that from a asset developer and also from a corporate perspective, this is actually quite a good situation. Yeah, this might sound weird because, of course, the average baseload price is pushing a lot of the costs to the manufacturing sector. But from a PPA perspective, right, just the kind of the basics of it is you have a high average price that gives the asset developers a lot of possibilities to beat CapEx cost, at least, let's say, from next year onwards for the next 10 years. And from a corporate point of view, you also have the chance to create a positive cash flow by fixing your prices over 10 years. Then in addition, don't want to get into commercial details here, but I think it's very uncommon to do inflation indexations in long-term PPAs. And therefore, this is... oh, okay. It's a bit too small. Yeah. But yeah. Now it's making a lot of weird noises, I'm sorry. So where was I? So basically, yeah, from a corporate point of view, so we have the backwardation creating a positive cash flow. the inflation indexation, and then also, of course, we have generally also some greenification targets. So this in total is creating, I would say, a good situation. Maybe not for right now, because the situation on the market is, of course, extremely tricky. But something like if we are moving forward to a more maybe normalization, let's see how the weather pans out. I mean, we've heard it this morning quite extensively. Then, yeah, we see some chances that there are more and more deals coming up. But in this environment, besides the uncertainty, of course, on how our price is developing, I think there were still some progress made, right? Over the last months, we have seen some deals coming through, but maybe not to that extent. And besides the role, of course, of the asset developer and corporate that I cannot personally speak for, I think there are also a lot of risks from a renewable energy trader that need to be considered if we are part of this kind of negotiation and if we are willing to take long-term positions into our book. And this is really, like, let's say, the second part of this presentation, where we basically just quickly want to go through some of the main risks that are currently being debated in the public sphere, so specifically margin risk and regulatory risks, but then also to look briefly at the topic of market risks. If we are starting with margin risk, yeah, we've discussed it earlier. Why is liquidity going down? I can just really echo that as well. I mean, when you speak of margin risk, then usually if we take one step back, there are two elements to it. It's the initial margin, which is pretty much your collateral payment that you put on the exchange. That happens in OTC contracts as well. And this initial margin is kind of aims to protect you and your counterparty that you're trading with via the exchange from a default on either side. So it is basically independent of the fact on which kind of position are you taking in the market. Are you taking a net long position? Do you have a net short position over your portfolio? It doesn't really matter. Initial margin is always based and placed on the exchange. The variation margin, on the other hand, is a bit more dynamic, right? And there was a lot of discussion, of course, in the last couple of months in the newspaper around the variation margin. And the variation margin in general is settled on a daily basis, right? And this is really the important thing to mention here. And it is trying to reflect the mark-to-market value of the underlying derivative contract, right? So let's take an example. You're net short, so you have sold more than you have bought. If then prices are moving up, basically your position becomes very negative. You have to add this mark-to-market value to the exchange. On the other hand, the counterparty that you have traded with, right, to keep it relatively easy, is of course a net long and receives the money that you have added through the variation margin as a positive cash flow. So in an environment like this, where we have extremely aggressive price moves upwards, a net short position becomes very tricky to handle, to say the least. And we have seen jumps in the end of August, I think, up to 300 euros, right, intraday. Then if you, on the next day, you have to place these kind of cash positions to the exchange, then this can be extremely hurtful. And I think one of the options that parties that are net short and that were in this situation, and this situation also happened, of course, towards the end of last year, can do is, sorry, now I lost it a little bit. Of course, is basically to buy back the energy, right? This sounds extremely brutal for the moment, because you might take a massive loss, but at least you're not running the risk to default. And this is exactly the debate that is happening around margin calls, right? Which can push up prices even higher. And commentators, right, and that's, I guess, also what is being discussed in the industry, have related, let's say, the end of August event, the December event, with just general margin calls, basically pushing prices higher, creating more cash requirements from traders, and these basically then having to make the decision, do I believe prices come down again, or do I have a sufficient cash amount that I can just place on the exchange to continue this? And from a mitigation point of view, there are actually not that many options, right, as an energy trader. So you have this position, so you can either try and move the position into the OTC market, so you just take it away from the exchange and you find basically the counterparty that you have traded with you on the exchange, and you're just duplicating the trade, and that's how you can reduce variation margin. But of course, like this, you are just moving risk from the exchange into the OTC, right? And this is an entire topic that I don't want to address, but there's also, of course, a question of credit line. What kind of contracts do you have in place with that counterparty to do these kind of optimization deals? And then the second one The second mitigation option is, of course, also to use cross-border positioning. So you're a European energy trader, you have positions in different markets. Of course, there are certain correlations between markets that you can use to offset your position, right? So you're long somewhere and you're short in another market, then you're basically flat. This works as long as the correlation between these markets exists, right? We have seen, though, also in this kind of tumultuous environment that correlations between markets that have been extremely stable over the last 10 years have been breaking down. So you haven't really mitigated anything else, but yeah, you have maybe potentially even added onto your risk profile. If we're looking now at market risks for renewables specifically, right, that's what I'm trying to highlight here. As you know, and I think we have discussed it, this is not news. I mean, renewables are intermittent. And so in comparison to, let's say, baseload generation or flexible generation, it's of course much more difficult to hedge on the medium to long term. So when we look at, let's say, at pricing of an offtake PPA contract, we usually refer to 6 different risks. And unfortunately, we don't have the time to go through each of them. But I think the main 2 risks that have also been discussed already with previous colleagues here on the table is the profile risk, right, or cannibalization risk. I think that's quite clear. You add a unit in a specific technology and it cannibalizes basically the capture rate of that unit from the underlying baseload. And then you have the volume risk, right, which can also be extremely expensive in this current environment. Just basically you don't know what the actual production will look like for the next year. You have hedged the volume, you have sold the volume already to be able to guarantee a fixed price, and that is the underlying risk that you are facing. So another graph. You can see in the x-axis, of course, the timeline. We're looking at the December contract, 21. On the left y-axis, that's the hourly spot prices. On the right one is the deviation to the average production in Germany. So from just a pure description point of view, right, blue line, we saw to December going from roughly 100 euros to almost 600 euros, if I saw it, and then dropping down quite sharply again towards the end of the year. I think we have discussed this already, right? Gas scarcity, general volatility, maybe a bit of margin calls in there as well, but also quite specific, and you can see that very well here and with the green graphs, very low onshore wind production. And this is really what I can just highlight here, right? You can see low wind production in the middle of the month, but also very high wind production at the beginning and at the end of the month. So overall, very choppy, not very reliable wind data. So it was pretty much all over. So if we're looking then in real terms, right, on the profile risk and the volume risk, then you can see, of course, that this high production volatility led to low overall capture rates. I think that does make sense, right? If you're moving into both directions all the time, you have high prices, then this can be extremely painful. And I think I mentioned in the introduction, you have roughly 80% capture rate in Germany on average for onshore wind, specifically for the month of December. And the capture rate in December 21 was actually only 72%. So this 8% deviation you either have accounted for by risk premia, or that's basically the risk that you are exposed to. And for the volume risk as well, as I said, you see a lot of green on the bottom half, so to say, and the deviation actually from the expected average production was roughly 20%, right? So these are volumes that you don't have in your portfolio, so that you have sold already in the forward market if you've guaranteed a fixed price PPA. So you will have to buy back these volumes at these kind of elevated prices. So yeah, I mean, in combination, I think I said low capture rate, high prices, low wind output. I think historically speaking, this was one of the worst months for fixed price PPAs in Germany. And are just difficult to hedge because these kind of elements are just always part of your portfolio. And then moving on to the last risk, regulatory risk. I don't want to go into too much detail here. I used to work in regulatory affairs before that, so I always feel that regulatory affairs and regulation in general is an omnipresent risk because sometimes it's there a bit more strongly, sometimes it's a bit further away, but it's certainly always there. And I think these kind of 3 examples really emphasize that. I mean, you have the first example, which is the current emergency intervention, and we have discussed it already. But of course, tumultuous markets create tumultuous intervention. So this has been a risk that cannot really be accounted for. Nobody has seen this 2 years ago, especially if we've looked at the kind of prices from 2019. The bidding zone split, on the other hand, is something that is kind of like a slow burner. We've been discussing this for 3-4 years now. We are hoping to get something, I think, next year with potential implementation in 2027. So you can see, usually in regulation, you have quite some good lead time, so you can incorporate that. If you're following the policy agenda closely, then you know what's coming. And you can, of course, try and protect yourself contractually by, I don't know, a change of law clauses, goodwill clause in German, Wirtschaftlichkeitsklausel. So there are certain elements to mitigate these. The last one might be a bit of a surprise, where this is a risk. But I think actually the previous speaker has already mentioned it, also in terms of capture rate. That's, of course, an important topic for us. If we're pricing a fixed price PPA for the long term, it's important to know how the build-out plan looks. Now, momentum of a new government is changing the build-out phase and the plan. Quite aggressive new targets, 100% renewable targets by 35. I mean, that's really big. If you're trying to account that for by cannibalization risks, then you have to make an assessment. Is that realistic, yes or no? So you're coming into a territory where it's really difficult also to look into the future, and that is also regulatory risk that we're trying to account for. And now moving on to the last part, and also trying just to leave behind a little bit the kind of last month. Overall, I actually have a very positive view on the PPA market in Germany. I think it has to be nuanced, right? And that's what we're trying to show here on the slide. It's not all bright, but I think the bottom lines is still that just from a purely German perspective, right? We have very good renewable targets and build-out targets. So we're trying to add more. We're trying to become greener and greener. So there will be lots of merchant PPA contracts. And these kind of last 12 months of seeing also short-term demand from asset developers, long-term demands, right? The price levels are there. It's just creating also this kind of knowledge transfer, and this discussion had to happen, and it really helped Germany to become a bit more mature, also in terms of contractual structures. And I think also what we've seen, for example, now in the last 6 to 12 months, a lot of new developers are actually also entering the markets. Developers that have always a little bit shunned the German market as being a bit too tricky to participate, they're all entering now. And I think this is also done to the promise that we still have a very unique and very big industrial industry with a lot of demand for corporate PPAs. And then on the challenges, I think these are all obvious, right? Cannibalization risk was mentioned, right? We have to see kind of how this develops also for long-term PPAs over the next 4 or 5 years or so. And of course, this also impacts the cannibalization risk and the risk profile in general. But of course, on the other hand, we have to see a little bit how the flexibility businesses are catching up with this development, right? As the bigger the cannibalization risk becomes, the better the environment should be for flexibility business cases to kind of narrow this down again. And this is exactly what one can try to follow. That's it from my side. I hope it was interesting. Contact details are here. I'm happy for any questions, but also, of course, afterwards via email. But yeah, thanks.
Thanks very much, Jan. Excellent presentation and an overview of the current situation in Germany and beyond. But first question would be, given the market situation, the prices at the moment that we see, surely a PPA would be a no-brainer. Why isn't there an acceleration of deals now from both developers and corporates rushing in to be able to secure prices at a lower price than the wholesale level?
Yeah, I think you can answer this 2 ways. I think first of all, from an asset development point of view, it's relatively a good case, right? You might still have some uncertainty regarding the regulatory environment and to see how price caps are developing and how will exactly the current discussion implement. From a corporate point of view, I think this is a bit more tricky right now, right? And that's maybe also where where we see kind of just a rethinking. Yeah, positive cash flow is positive, but, and I'm very curious also for the next presentation, so maybe there we get even a better answer to my response here. Positive cash flow is positive, but yeah, let's see how the prices are developing. We have heard today that a lot of people are expecting the prices are not going down. It is weather dependent. So let's say in January our storages are full. Maybe prices are dropping, right? People are hoping maybe prices are dropping. I don't know. And then the last part I can just say from an energy trading point of view, there's significant risk right now. It's very expensive to do long-term hedges in the market. So this is of course also slowing down just kind of deal making.
Yeah, for sure.
Yeah.
I mean, we still haven't got the clarity on this intervention, the 180 euro cap, revenue cap, but is there possibilities that PPAs could be excluded from that? And if so, would it be possible to do like a sort of one-year PPA?
Yeah, I think, one-year PPAs have been in fashion, so to say, for the German market, and I think the markets in general will be, I mean, the different basically forward curve, etc. day-ahead markets, they all will be part. I mean, at least that's how the current proposal can be looked at. But I'm not aware of any discussions that kind of shorter-term PPAs can be excluded. I doubt it, if I'm very honest. They are usually running in a regulated system and have the feed-in tariff. That's the base income that they have as a guaranteed income. So yeah. I think, but for the longer-term PPAs, it's less relevant. I mean, we have seen the average forward curve being at 200 euros. If you discount all the market risks that we have discussed, cash positions, etc., then you're definitely below the current cap.
Absolutely. Any questions from the audience? Just we have one here and one.
Hi, Jan. This is Simon from Baringer. I think I have two questions for you. Number one, I was wondering if you think pricing in a shorter term would be decreased to 180 euros given the cap. So what incentive would you have to price, let's say, the next 6 months or so above? And question number two is pay as produced versus base load. When you talk to downstream clients, they complain a bit.
Yeah.
So they would expect that someone can manage profile risk better than they on their own. And so when do you think that baseload contracts will return to the downstream?
Yeah, that's a very good question. I mean, baseload contracts, right? Essentially, if you are signing or agreeing to a baseload contract on the corporate side, then you remain or you keep the cannibalization risk, right, in your book, some of the other risks as well. And just with the build-out that we have seen, right, I think, and also you also usually take the kind of liquidity of the curve into consideration. So what you can do is maybe offer a baseload contract for 2 or 3 years as long as there's liquidity, because then you can manage your position a bit better. Otherwise, you run kind of also in price risk scenarios, right, because then you're just rolling your position throughout the curve whenever there is more liquidity. So it's a difficult topic, right? And right now, I think there is still a lot of interest also for as forecasted structures. Maybe not in the kind of scale that we would need, right, for this kind of build out to happen on the renewable side. But yeah, I think we have to take it from step by step. And I think what will also happen, as it happens in other European countries, is that once you really come down this kind of direct PPA road, where basically the corporate is concluding deals with the asset developer themselves, then it's a question what is the role of the trader, right? It's about then shaping the risk, etc. It's maybe taking balancing risk, and yeah, I think there are always ways to continue the relationship here. And the first question I couldn't acoustically really understand. Sorry about that.
I was asking myself if you would take the 180 euros price cap, if you would take this into account when you price PPAs.
Sorry.
If they start now in Jan or not?
No, I think it's not relevant for us to take that into account in the end, right? I mean, we really have to wait for the final proposal on how it's implemented in Germany. But let's say the proposal is implemented one-to-one like that in Germany, then our role is just we're hedging the price in the market, we're paying this out, and currently we're speaking about a 4-month period. So anything beyond that, right, is kind of a big question mark behind it. So we are pricing on the market, right, on the risks that we see. But essentially, and as the proposal currently stands, the asset developer will have to pass on potentially the kind of over revenues that they have realized.
And the final question from Henning here. I think Sebastian is coming with a microphone.
Well, thanks. It's actually a slight follow-on comment, because I'm quite thankful that you gave a sort of an outlook that's, despite the crisis that we're in, you know, sort of semi-positive. And so we work a fair bit with long-term investors like pension funds, most of them non-European, and their interest in Europe this year has picked up significantly, because they're saying, well, you know, the high energy price for us as an investment is a signal to invest into domestic and clean production capacity in Europe. Then they say things like, okay, there's a skilled labor base, infrastructure, despite some, you know, the Deutsche Bahn not really working that well, and Autobahn construction is actually quite well developed. And there's the industrial demand base, and they're thinking, well, you know, after this crisis, there could actually be a really conducive investment environment, especially because the political supportive schemes like subsidies are in place. So I think, you know, hopefully when we're through this crisis, I think it's quite an important thing to keep in mind that not everyone is doom and gloom about Europe in the long term here.
Exactly.
So thanks.
Thank you, Henning. And that's what I was going to round up by saying thank you, Jan, for offering us some rays of light out there. And here's a little present from us. Thank you. Thank you, Jan.
Thanks a lot.
Thank you. Thank you. Now, in the final session before the break, well, we've talked a lot about renewables, we've talked about fossil fuels, we've talked about the market interventions, but I think at the core here is, and we've seen it referred to many times, is what's the view from industry? What's the role here? What's the outlook? So I think it's great to have you here, Stephanie Müller of BASF, and she will give us her views on what it means from industry. Is Germany's stronghold, industrial heartland, is it under threat or not?
So, yeah, hi, I work for BASF Renewable Energy, which is a company which was not founded not even a year ago. And it's aiming to supply the BASF group with renewable power. And for those of you who don't know BASF, it's still the largest chemical company in the world. And I'm not so sure if I'm the right industrial representative as BASF to answer all these questions I think you're having, because we have always been on the producer side and also on the consumer side, so we're a little bit of in between. So, but besides chemicals, we also have some quite ambitious CO2 reduction targets, and we committed to a 25% CO2 reduction by 2030. And we want to achieve net zero emissions by 2050. And this is backed by around 4 billion euros of investment, which we want to take by 2030. And doing this, we have identified for us, for our company, 5 major levers to reduce our CO2 emissions. Okay. So the gray to green swap and the power to steam levers are for us the main ones to actually reduce our CO2 emissions. Because, as I said already, we already have, or we still have, fossil power production and also fossil steam production. Our upstream emissions we want to tackle by new technologies, and we also want to focus on bio-based feedstocks to actually replace our fossil-based feedstocks. And then in addition, we also have continuous OPEX measures to actually focus more on CO2 reductions on the longer term and also focus on efficiency. But we also have to say that compared to our 1990 emissions, we already reduced our emissions by 45% and at the same time doubling our production. I've also been talking to some of you during the breaks about offsetting. For us, offsetting measures are only temporary measures to actually bridge the gaps until we develop all these new technologies, what we need to become zero or climate neutral. So what is our overall strategy behind that? So we are actually talking about the electrification of our main processes. so of our main manufacturing processes. And that means that we are talking about doubling or even tripling our electricity demand by 2040. Last year, in 21, we already covered our power demand by around 60% by renewables. In 2030, we project that we will cover around 60% of our power demand by renewables. And then compared to what we consumed last year, this will mean that in 2030, we will be on 100% compared to 21. But to give you an idea what this actually also means is, at our biggest site in Ludwigshafen, we consume around 6 terawatt hours per year of electricity. So this equals to around 1% of the German power consumption. And we want to make this transformation by combining a make and buy strategy. So as I've said in the beginning, we are already a producer, and we still want to be also on the producing side. So this is why we're not only focusing on buy, but also on make. So we are selectively investing in our own renewables projects, but we also, of course, buying PPA projects. So here I brought you some of our current projects. The one which is our highlight at the moment for the make case is we bought a share of the HKZ wind park last year, which is the largest offshore wind park in Europe. And this is currently being built up. And we received the first power in August, so last month this year. On the buy side, we just announced a 250 megawatt PPA in the US, which will cover around 20 US sites with green power. Since the beginning of the year, we also have a PPA running, also a 25-year PPA running, where we source power from Spain, and it is also distributed to a lot of our European sites. And as you've seen, some more already in the pipeline, and there are also more to come. But of course, and as we have seen already today quite often, and what we also heard quite often today is that of course politicians are trying to intervene or intervening in the market quite heavily. So we also see this as a problem, challenge, and for us there are 3 main points at the moment. So of course we have these high power prices. And in our point of view, and as we already seen today, these are also a result of scarcity. And I don't think I have to repeat it, but I mean, we have the nukes problem, the hydro problem, the gas problem. And in our point of view, scarcity would occur in any free markets. And the only, or the most important thing to actually tackle scarcity is to increase the supply. Due to this situation we are currently in, and which is also caused by the scarcity of supply, of course we also support emergency government support measures, but in our point of view they should be short-term, and they should focus on stabilize the society and the economy. And we are not a fan of the market design to be touched. In our point of view, there are alternatives which should be preferred instead of a revenue cap. And this would be a reduction of fees, levies, and charges. And they make up currently around 40% of the end consumer price. And in our point of view, this would be a very quick, or would be measures which could be implemented very quickly without, with not as much bureaucracy as the revenue cap would be needed. And they would also show immediate results. In regards to the structural reforms, we are a fan or a supporter of the current market design because we think it's the best known mechanism to actually meet supply and demand, and also what we need in the future to actually bring in also the flexibility side on the demand side. And as Tekla also pointed out already, and a few other speakers before also, we think that market intervention, and especially to the market design, jeopardize the capital availability and also the investors' confidence. So for us as BASF, it is very important, to fulfill our net zero emission targets. And for that, as you've seen, we need a lot of power. And for that, we need a lot of renewables. And we not only need renewables, but we also need them at competitive prices. So we identified two major conditions which we need to actually fulfill our targets. And this is what has been talked by some of the other speakers here as well. We see it that we need investment in the right infrastructure. So the expansion of the renewable power assets, and we've just seen the numbers for Europe and Germany. We fully support this, but we also think that it's very important that this will actually deliver. We've also think that it's very important to put more investments into grid infrastructure, not only in Germany, but also on a European basis. In regards to the right regulatory framework, we're not a fan of profit skimming, as we call it, and can see it here in the brackets. We also don't like CFDs. Yeah, as I said before, we need reliable and accelerated approval processes for assets. I think Tekla also mentioned it, bringing assets, and especially bringing new assets into the stage where you can actually start to develop them takes a lot of time and is hindering also the expansion targets. Also important for us is access to green power attributes. So for the GOs, we're not a fan of national measures or national strategies to limit GOs to certain countries or certain bidding zone areas, but we also want to highlight here that we are on a European market, and we think that the GO market should also be a European market. And then, of course, the reduced fees, levies, and taxes. We're still a chemical company or an industrial company. And as I've said before, regulation must support investments. So again, we're not a fan of influencing or intervening in the market design. So yeah, for us, it is very important to actually reach our own targets. And for that, we also need the market design and the regulation design to be kind of stable and not to bring in another storm from outside. Thank you.
Thank you. Thank you very much, Steffi. Excellent. A great short overview, which is perfect because it means we can go off to have some refreshments or some coffee in a minute. But just a couple of questions. You mentioned intervention. You mentioned, do the fixes without, the things that policymakers can do without having to tweak the market design as such. But are you confident that what will emerge, in the coming weeks will actually work, or that is something that you and industry generally will welcome?
You're talking about the revenue cap?
For example, yes, yeah. That's one emergency measure that's being touted.
Yeah, so when the discussion started about what's possible, or when the politicians started to talk about the intervention mechanisms, of course we also talked internally, and then we came up with this position. Because for us, on the one hand side, we invested in renewable projects, and as we heard already today, it's not clear yet who should bear the 180 euros, so who's actually paying for that, or whose profit is skimmed. On the other hand, of course, the whole distribution mechanism to the consumers, where of course also industrials belong to the consumers, is how do you make this clear? So how do you get the subsidies back as a consumer? So for us, it's a very bureaucratic measure to actually distribute the profits to the consumers. And this is where we came up with the idea of would be very easy if the government just paid for the surcharges you have on the power prices, and this would have an immediate effect, and it would not influence this market. And as I heard already, or as I heard just before, that it should only be in the market until March. I'm doubting that the politicians will actually, or that the market can handle this until March. I think we need a lot of time to actually to implement a revenue cap and then the distribution mechanism to bring it to the consumer.
And then it's maybe unlikely that it would actually stop in March, or it's probably more likely to continue. Yeah. I know that in the panel discussion earlier, Nathan asked the panelists about rationing. Are you worried about the prospect of rationing over the coming winter?
For gas?
How worried are you?
For gas or for power?
Both, yeah.
So I work for BASF Renewables. I'm not responsible for gas. But for the power side, I mean, our power plants in Ludwigshafen, which is South Germany, they're labeled as, so they are labeled as that we're not allowed to shut them down. And so far, the regulation was that if there is a shortage on gas, these power plants should be able, or should be on the front runner to actually get gas. And then, of course, it would be for the private household customers to supply them with power. But I mean, it's right in the middle of the heart of the industrial BASF city. So I don't really think that there's going to be a rationing, but we'll see.
We'll see. Yeah. I mean, we had all the mitigating factors here, you know, and if we get a beast from the east again, things could change quite rapidly. But any questions from the floor for Stephanie? Okay, so your message was loud and clear, Stephanie. Perfect. Here is a little present from us, and thank you once again, Stephanie. Thank you. Thank you. We are now back on track, and I think we will take a short break now, and to see you back here in half an hour at 15:40 or 20 minutes to 4. Thank you. We've been talking about a number of different subjects, but one aspect we return time and time again to is the market intervention on the table by the European Commission. It's not been a separate topic for any of the presentations so far, but almost every speaker has referred to it because it is of quite severe magnitude and could have a huge impact on the functioning of the market as it is. So we will delve deeper into the aspects on the table, what is not on the table, is the market broken, is it not, and how to fix it. But the first session today, it's a great honor to have Anna Stanic here, who's partner at DNA Law. So Anna, you will talk us through, you know, the threat of re-regulation and your views on that. So a warm welcome to you, Anna. The floor is yours.
Thank you. I'm going to try not to move because I have to hold this thing in my hand. So we'll see how that works. So I understand that earlier this morning you've already discussed or touched upon some of the proposals of the Commission and that it included, if I'm right, Richard, it included also stuff to do with gas or the price caps on gas and stuff like that. So my proposal is to sort of tell you what I understand of what is going on, and I'll start really with the electricity, which is an official document that is on the table, which is from the 14th of September of this year. My understanding of it actually is slightly different. It's meant to last at least a year, so it's meant to be till October of next year. I do believe that therefore the intention will last longer than that, but it's made of 3 parts, I would say. The first part is the reduction in demand for electricity, which which the idea of it is, we're talking about a 5% reduction. And in the scheme of things, it's telling us that we're talking about achieving 1.2 BCM in 4 months. So that gives you an idea of how little an impact it's meant to have, and therefore the little ambition that it actually really has in terms of where the demand reduction is going to come from. If we go back to 18th of March and the first Repower Europe document, which was the one that announced that we were going to have reduction of gas by 75% of this by the end of this year, we can see that they're scaling back on their ambition from the point of view of achieving anything other than through the other parts, and that's the cap and the rest of it. So that's the first part. I'm not going to go into the mathematics of how it's calculated, but obviously the key aspect of it is that they're trying to capture the 4 hours of peak demand, and they're trying to reduce it between 5 to 10%. The second part of the proposal is to recover what they call the excess revenues from the generators with what they call is the inframarginal technologies. And there's a list of what that is. And yes, it's true, it doesn't include coal at this point in time. And there is obviously this price cap that has already been mentioned of 180 megawatt hours. That's the second aspect of it. And I think you've discussed enough about the issue of how does that figure come up to be 180, whether it's realistic. It is intended to include future projects. It's definitely intended to include all of renewables projects. So it has obviously a huge impact. And then there's a third aspect of the proposal, and that is the solidarity mechanism. And the solidarity mechanism is another mechanism that hits specific industries, and it basically hits any company that is a EU company or a permanent establishment that generates at least 75% of its turnover from oil, gas, coal, and refinery sector. And if you are in that bracket, then you're going to be paying a solidarity contribution, provided that your profits in 2020 were above 20% higher than the average taxable profits you had in the 3 years before. So there is the cap, and then there's the solidarity mechanism. Both of these mechanisms are meant to then, as was explained by the representative from BASF, be used to actually then compensate energy-intensive industries and other final consumers for the higher prices that they're experiencing. So that's really, in a nutshell, that proposal. What that impact that has, I think we've heard, and it's, as a lawyer, I won't say other than other than to say that obviously there's potentialities for numerous amounts of claims, not just claims against the states that introduced this in the EU itself, but also between companies, as this becomes quite difficult to manage in terms of domino effects. There is a price cap proposal on the table also with respect to gas. As you may recall, at one point in time, less than 2 weeks, 3 weeks ago, I think it was the 5th of September, Ursula von der Leyen announced that she was going to decouple gas from electricity, and that also that we needed to have a cap on gas prices. Initially, the idea was to potentially cap Russian gas prices, but then we hardly have any gas from Russia, so it becomes pretty irrelevant for the purpose of the market to cap their price. And also, if you were to do that from a legal point of view, that amounts to effectively like a sanction, which then means that you need unanimity at the EU level to adopt it, which, even if it's just Hungary that doesn't vote for it, means that it's unlikely to go through. In any event, the argument has moved forward. Loads of countries, including Netherlands and others, have argued that the cap needs to apply across the board to all of gas being imported. We are assuming that that is not really going to stay on the table, because obviously Norway, the United States, and all the others are not exactly eager to see this cap materialize either. But the talk of certain countries in terms of how the cap would work. Some of the proposals are suggesting that the cap would be linked to the Henry Hub plus margins plus transport, whatever that figure would be, which would either put the majority of the US contracts in the market, as in they would be effectively below the cap, so they would be still making all the money under the contract. But presumably, and that would be fine presumably also for the Norwegian long-term contracts that are oil indexed, but everybody else, and presumably the Qataris or anyone who's on a TTF contract would need to then figure out how that cap would work. There's another proposal in terms of the price cap, and that would be one which envisages the TSO having a balancing model, settlement mechanism, whereby, and this is the part that then becomes quite difficult to understand how it would work, because presumably if we all know that the TSOs are going to be able to make gas available at a certain capped price, which at any point in time is considerably lower than the market, then presumably the market will just all bank on buying it from the TSO, and therefore then the TSO would not enough have gas to actually settle the balancing settlements, and this is part of the explanations that we have been putting forward to the Commission as to why this particular proposal of capping gas prices won't work. But as we say, we wait to see what new brainwaves will come from Brussels and then try to respond to those. I don't know if there's any point in discussing, or if there's any interest in discussing what is happening with the idea of a price cap on Russian oil. I mean, other than to say that, I mean, the G7 has said that that's what it will do before the end of February or the beginning of February of next year, by which time all of shipped oil from Russia is banned coming into Europe and only piped oil is allowed in. And the idea is basically to have a cap on Russian oil that is otherwise floating in ships and or coming from third countries. And the idea is, and this is why the insurance industry is not happy about it at all, is that the insurers would be the ones that will actually be enforcing the mechanism, because they would be the one having to check at what prices the cargoes of oil were actually on their ships. So there's a lot of discussions as to how that will look like between now and February of next year. Suffice it to say that the risk of regulatory risk is just enormous. And the idea, and I think this is where I entirely agree with the previous speaker, that actually the market is reflecting the incredible uncertainty that is in the market. And part of that uncertainty, or the majority of that uncertainty, is actually driven by politicians. So their ideas of how to fix it is actually generating more uncertainty and anxiety. On the other side of all the price caps and all of these things that they're trying to do, they're also trying to give us sweeteners by way of subsidies. So we're now talking about whether and how to fix the issue of collateral with respect to energy trading, which we heard a bit about earlier today, but there's also the enormous amount of subsidies that are intending to be paid, particularly to energy-intensive industries, to offset the high prices. So we have this kind of, we're fixing the market and all different sides and ends of it. And just to give you some sense of the size of this, obviously just Germany, which you will already know, is talking about 100 billion euros in subsidies before the end of this year. That compared to obviously then other member states is another aspect of the debate of the destruction of the internal market operating at all, because obviously nobody else can compete with 100 billion injection for energy-intensive companies for a particular state. The rest, like where I come from, Slovenia, that's 1.5 our budget for GDP for the year. So the idea that we can help our industries in the same way is not a realistic thing. So there's a huge amount of political discourse and threats, as you can imagine, also to the entire functioning of the European Union or the future of the European Union as a result of what's going on. And maybe just to end is really on another topic that is not so much about re-regulation, but just an idea of how much the governments are now involved in what would otherwise be day-to-day management decisions of energy companies. Uniper, who was obviously nationalized just yesterday, but before it was nationalized a few weeks ago, as part of the bailout that the government had given it, made a demand on the CEO and the management board that they had to drop the case that Uniper had against the Dutch government on the phasing out of coal and the lack of compensation. And so that was actually a demand of the bailout. Unless the management agreed to drop the case, they were not going to get the money. So presumably the management had lawyers and has gotten a whole load of disclaimers and protections. But what I'm trying to say is that the kind of demands that are being put onto the energy companies goes beyond anything we've seen so far. And maybe to end just on a point on the PPAs, I wouldn't bet my money on a PPA buying me any security for any of my projects going forward, unless I get basically what we call standard, stabilization clause in my contract or something else from the government. Because if you all remember, and it's not so long ago, which is what, between 2000 and 2005, the European Commission declared all PPAs that were signed as part of the privatizations of electricity and other companies in Poland, in Bulgaria, in Hungary. It declared all of those PPAs as state aid on the basis of a very simple statement that they made, and that is that long-term contracts are in themselves uncompetitive, and therefore they are not market. So you have that, and if you don't believe me, you can read the Dunameti case, because I quote it all the time. And you will see a fascinating discussion about how profit margins are not part of the market. So yes, so beware of that as you try to renegotiate the future of energy companies. Thank you.
Thank you very much, Anna. I have a number of questions for you, Anna, but I was wondering I could maybe put them to the panel later, which will you be joining. But maybe there are some questions from the floor. Yes, Nathan.
No doubt this will come up later on the panel, but I mean, how long can Europe sustain these kinds of energy prices before it deindustrializes?
I think in my view, it's already passed. Yeah. I think we're late. I mean, I have found myself advising aluminium companies and glass factories and so on around Europe as a result of the situation, which I've never had to do before, and I've no idea what the solution is.
So some of those shut-ins just aren't coming back?
I think so, yeah.
Will they move abroad, away, out of Europe? I mean, there's high energy prices in other parts of the world as well.
Well, I suspect that that's right. And the only problem is that the workforce won't, so people will have no jobs.
Yeah, absolutely. Any other questions? Yeah.
Matthias Bertram, Centric Energy Trading. Sorry, I just have to respond, as I think we heard something that was just shooting down that one bird of optimism regarding to the PPAs. But you know this wonderful organization in Ljubljana, and
called ACER.
Exactly. And please, can you comment on this, at least in the regards to them also stating, you know, how can we add more liquidity to the forward curves? How can we increase, or suggestions how to increase the PPA market and make it more lucrative for consumers also to sign long-term deals, and also the fact that we are looking at an electricity market that is has far developed from what we looked at in 2000, 2005.
I'm not sure what you're asking me to do, but I'll say that ACER is actually on our side, on the energy market side, I would say, at least from my workings with them. But as they say, they're not even invited to the main discussions on any of these things. So they are at least one circle removed from, or the ring removed from the ultimate discussions because they supposedly, well, they don't have a role. Because as you know, they're not recognized even as a European agency in that respect, and because the mandate was refused to be given to them by the Commission. So the Commission officially makes all those decisions. So,
but you agree to that we are looking at a different market than we had in the 2000.
It does. Yes, we will always be looking at a different market, but that doesn't change the arguments that will be invoked to unwind projects when they decide they don't want them anymore. And I think just if we just look at nuclear, within less than 6 months, we've gone from no chance of there being nuclear to now nuclear being taxonomy. We'll see what the challenge in the court takes. But there's no guarantee that they're not going to change their minds halfway through the building of nuclear, because that seems to be what the politicians do. And the one thing that we no longer have, and that is investment treaty arbitration as a mechanism to protect investments. So we are now relying solely within the European Union on the European Court of Justice to decide ultimately on whether something is expropriation or whatever else they're going to say, and ultimately their understanding of concepts like legal certainty, legitimate expectation, are completely different, I would imagine, to German constitutional law, and they're certainly completely different to international investment law. So we are actually in a circumstance which is quite unique in the European Union, where the rights of energy companies vis-à-vis the EU are less than other companies have in other parts of the world or within the EU as foreign companies. So these are significant risks that we now have. That's why we need to talk about stabilization clauses, and we need to have a completely different approach to how we draft contracts and our relationship with government. It has to change, because they have changed the goalposts, and the goalposts are not the same as they were in past. And they will use the need for climate change and for radical, I think it was on your slide, radical regulation as a justification that anything that they promised before is no longer valid. And that includes dropping hydrogen if they feel like it in 5 years' time. That's my view. That's my, I hope I'm wrong, but that's my view.
Me too, thank you.
I mean, that's not exactly creating investment certainties or a stable market. But okay, Anna, I think that's some quite bold and almost controversial statements there. But thanks for that. I think that brings the discussion on, I think. So please, could you, before you go, we have, well, I'll give out the presents a bit later. So if you could take your place on the panel, please. And I'd like to invite Jerome. Thank you. Yeah. And I'd like to invite Jérôme Lepage, who's chair of the EFET Electricity Committee, Tekla von Bülow, who we met earlier, and joining us today as well will be Simon Tuwishik, director at Baringa Partners. I hope I pronounced your name right, Simon. Almost, yeah.
Hi. Nice to meet you.
Yeah. I'd like to break this into 3 parts, really. First of all, by isolating what the problems are, then looking at the short-term emergency measures and also more longer-term fixes of a market. But, Jerome, if I could start with you, is the market broken? Does it need fixing? Or is it really, as has been highlighted by other speakers, is it a scarcity issue here?
Mm-hmm. Thank you very much for the invitation. I'm happy for this first question, because indeed this morning we heard about the market being broken, the market being broken, the market being broken. My feeling is, no, the market is doing exactly what it should. It's reacting to a series of fundamentals, to risks that are increasing in many different areas, and it's trying to allocate resources in the best way it can. Now the question is the market giving the results that we or that politicians want? Probably not. But that's another question. That's not a market being broken. That's a market delivering what it was supposed to deliver, like in the way it was designed. That doesn't mean that there's nothing to do. So like the way, and we'll discuss that later, as I understand, the way we can tailor how to cater for affordability of energy supply to consumers, be it domestic or industry, how we cater to security of supply, and yes, we forgot about decarbonization for a minute, but it's still an objective of the EU and member states in general. Yeah, we may need to rethink a few things about how this market is organized, but fundamentally it works. And for the moment, it's the best thing we've found to best allocate resources. So we hope we keep those building blocks and then build on how to design mechanism to ensure those elements of security of supply, affordability, and decarbonization.
I think absolutely. At the core of what Stephanie talked about, but also what you mentioned, Tekla, was the marginal pricing or the merit order. Now that seems to be under increasing attack from certain policymakers and both at the national and the Commission levels. What's your view here? Is it still fit for purpose? I mean, Ursula von der Leyen seems to think it's not fit for purpose anymore. What's your view?
I mean, it seems to be the scapegoat for a lot of discussions, on rightly so. So I fully second what Jerome is saying. The marginal pricing is actually not the issue. It is exactly the way it was set up, and the very high prices that we're seeing in the market is showing, it's just a sign for the fundamental issue, which is we don't have enough gas available, and we don't have enough coal and hydro available, and all of and nuclear going down. So all of these are volume-driven effects that are one-to-one then shown into the pricing. So very weirdly, all of the discussions that we're having is in terms of capping the price, but the bigger issue is the volume. There's a lot of discussions going forward whether the market design that we have is still going to be the right market design in the future. There's different propositions long-term on the table, whether it makes sense to sort of split up the market, for instance, between kind of the volatile renewable generation capacities and the fossil fuel ones, so you have two separate markets in order to allow a kind of a decoupled pricing and have kind of more fairer prices, especially kind of for the renewables. That's, for instance, a proposition made by Greece, and could be something that needs to be discussed, really, frankly, on a European level. But the reactions that we're currently seeing really is based on very much the way the market design was set up. I think nobody would have expected a situation that we're seeing currently with the gas prices skyrocketing so badly and sort of having this perfect storm, which effectively has a massive impact on consumer prices, not only households, but obviously the industry. So it's quite challenging. We need to find a solution, definitely, to get out of the current crisis. But the fundamental question of whether a marginal pricing is wrong, I think, is a concerning discussion that we're seeing.
Absolutely. So, Simon, what's your view here? What needs fixing, if anything? Let's try again. Yeah. Testing. You can try this one in.
Yeah, I think it's a very big question, and it's something for the economists probably to consider and reflect. I can probably second what Jerome and Tekla were saying. Marginal pricing doesn't work particularly well at the moment for political reasons, but it does what it should be doing. It shows a scarcity in the market and creates investment incentives. Does it help us? It doesn't, because the investment will take a couple of years to be visible in the market. I guess what I would like to probably more comment on is the price cap. So kind of intervention, I think, is a right one. So the politicians need to intervene into the market to create more, let's say, more justice distribution between producers and consumers. However, there are few complications in the way the price cap has been announced. I know it's just principles, and we are waiting for more detail, and some of the complications may disappear. And Federico, I think he also mentioned earlier today, a few things which are difficult and how they should be managed. But if we look at the market from a production perspective, many producers have been already contracted in a forward market below that 180 euro cap. So potentially there's not much you can get from them. And their contracts can be with downstream companies, can be with trading companies, which it might be difficult to find the money effectively and bring it back to the government. And as mentioned, the trading companies may have very clean book structure, may have a very confused book structure, so it could be difficult to track the revenue. There's also the concern about churn and effectively also around costs. So selling 480 or above 180 euro doesn't mean this is our profit. There are also imbalance costs and other marketing costs which need to be reflected. Last but not least, this 180 euro cap also creates some confusion on the downstream sector. So it's unclear if they should be going to the market and try to find some cheaper PPAs, or if they should wait for the government come to help, so effectively be exposed against the spot price. So in my opinion, we need clarity pretty soon, especially also because some of the asset owners like pump storage, like battery producers, lignite, coal and oil assets, they might not have the incentive to produce electricity in the next couple of months.
So in effect, there's sort of a state of limbo until we get more clarity. You brought us nicely onto this 180 euro megawatt hour cap. If I can continue the discussion there on we've discussed it quite a lot today, but there are a number of points I'd like to bring up. Anna, next week, the EU energy ministers will meet. Do you expect, will we see any changes to what's already been proposed? And will this be pushed through fairly quickly?
Well, I think the pressure is to push things very quickly because the situation is serious. But I think the result of that will be that whatever's pushed through will not exactly be thought through. So that's I think the problem with it. I think my main concern is that the 180 figure, however way it's defined and however it's calculated, is only probably going to get us to a certain point in time, which I assume by February, March will become an irrelevant figure, because if we are going to remain at least 90 BCM short of gas, by then the market will be in seriously uncertain times, and then the whole issue of demand destruction. I mean, the one way to solve this will be just let's get the demand destruction done, in the next 3 months, destroy all of industry, and then we don't need the gas anymore, and then that's perfect. Then the politicians have nothing to worry about other than to pay people to stay at home So then that's their solution. But ultimately, they are refusing, and this is the problem in our discussions in Brussels, they are refusing to even open the discussion of what happens in February, March. Okay. And so with that off the table, then all the discussions about what's that is also completely pie in the sky, because actually the crunch is not even now, the crunch is later, but we all know it's there, except for the politicians who don't want to listen.
Because the crunch will come maybe the winter 23, 24?
No. The crunch will come as the storage is emptied, assuming we have assuming we have a mild winter and we get through this with the 50% demand destruction, which they seem to have been happy to accept, which I can't understand how we are accepting, but they are effectively accepting. They're saying that we've achieved it through energy efficiency, but actually in the majority of countries it won't be energy efficiency because they're not energy efficient, and they can't possibly have become energy efficient in 3 months. So the crunch comes when there's no gas in storage, and there's no more the 155 BCM of gas that we've relied on every year from Russia. If it doesn't come, and we've calculated where the rest would be able to come, but we're about 90, at least from what I can understand, we're about 90 BCM short.
Even with this massive expansion of LNG terminals?
Yeah.
Yeah.
Well, yeah. Anyway, I might be wrong. This is the figures that I get given as a lawyer. Yeah. So I don't know.
Yeah. Jerome, I mean, we've heard from several presentations and from questions from the floor that, you know, the implications of this cap on the forward market. I mean, does it effectively just kill it off for 6 months? I mean, what's your view here? What are your other concerns with this emergency measure?
I mean, maybe going back to the theme of your first question, like, is the market broken or do we just have a scarcity problem? I believe the market is not broken and we have a scarcity problem to start with. So the most important measure that we should be discussing is around demand optimization, demand reduction, while trying to avoid demand destruction. And so this is the kind of like the initial part of the emergency regulation that was proposed by the European Commission and that will be decided on probably on the 30th of September. But there's very little talk about that. There is very little talk about how little member states have been doing on demand optimization, especially. I think out of 27 member states, like 2 or 3 have completed the implementation of the electricity directive on demand response elements. And now they want, like, the Commission to come up with proposals around demand reduction and demand optimization. So that may be a little bit hypocritical. Now, on the caps themselves, so that's a measure to treat a symptom, not the initial problem, which is the scarcity and all the uncertainty it creates. The effect on forward markets are highly unpredictable, just because whatever we have on the table, we shouldn't imagine that for the moment, as the text stands, in terms of what the Commission proposed last week, that we're gonna have one system that will be implemented throughout Europe. For the moment, the text leaves vast leeway to member states to do whatever they want, starting from playing games with that number of 180, which seems to be the only fixed thing in this draft regulation. And then in terms of implementing the whole cap, so what is taken into account? How do you look at forward trade from PPAs, 10-year PPA until like 5-minute or 0-minute balancing, like arrangements, this kind of thing? What is taken into account, and how do you take account of, I'm a Belgian producer, I hedge in Germany? What's there? So yes, so the impact on the forward markets, we can't really assess it right now. We've seen that forward markets are like having severe liquidity issues at the moment. This is not improving the situation. So there's a cycle of indeed market creating results that politicians and policymakers don't really like. Then in turn decision makers trying to get into quick fixes and decision making, probably getting it wrong, or not getting the right fixes and the right details, and that increases political risk. And that's one of the things that makes prices go higher. So projections about where the prices would go in 3 months, 1 year, etc., I can't give you, just that the situation right now is not getting things better.
Absolutely. Tekla, have you done any analysis or into how it will work in practice, this kind of cap, this revenue cap, and what in terms of the implications for the renewables and PPA sector?
No is the answer, not specifically on that. We have done a lot of different analysis, but I mean, for the PPA market, effectively the big question is how's the PPA market going to be affected going forward? The cap really applies only to PPAs that are above 180. Most PPAs are below. So in that case, will not directly be affected. Fully agree with Jerome on the forward market. The liquidity has just gone down substantially, and what we see on the PPA prices, especially between developers and utilities, is that the utilities are putting enormous liquidity premiums on the PPA prices. So where they were around 20% beforehand, they're above 50% now. So they're just not willing to take the risk for a PPA, so that developers have the option of either going spot for the moment or just going full risk. Or waiting for the projects, I guess. So it's not, as I said in my speech, not going to accelerate some of these projects for sure.
No, Simon, we'll try again, see if your mic's working.
Test.
Yeah, it is. Respect that. It's good. There are other proposals there that the Commission came up with, and one of them was looking into the TTF benchmark reference price and wanting to tinker with that. What's the issue here, and what's your view here? Does that actually need fixing?
Yeah. So let me just come back to the point from Tekla first, and then I take on a TTF question. So I think one thing you can do around pricing, understand how capture prices are impacted. You obviously can model the markets and then model it on, and then every hour where the price is above 180, you cap the income of a renewable asset. So you can do some, let's say, projections of the income effect. You also can do that whilst you decrease the electricity demand. So you also can take some lower demand into account. I guess the problematic bit is there will be obviously some weather effects. You don't know when the cap ends, and yeah, some of the income might be also secured via PPA. So what I'm seeing is that the new build projects are probably not as affected, but there is some concern and some fatigue in the investor community, because it's more difficult to judge on the value of an asset than it was before, especially given the fact that you don't know if it stops in March or takes later. So that makes things more complicated. And then your question was on TTF.
On TTF and
whether
reforming
or not
the benchmark.
use it as a benchmark to cap the gas price, or
that it was not fit for purpose anymore because it was formed, as far as I can understand it, on the basis of pipeline gas. But once those have disappeared, the flows from Russia that Anna has mentioned, but once they disappear, then it's going to be based much more around LNG. And does the TTF then fit that kind of market dynamic? I think that's my understanding of it. I don't know.
Indeed. So Russian gas was very often a price setter for the TTF, if not kind of the dominant price signal, as far as I remember for my gas market times. So given the absence of the 70 plus BCM pipe gas, LNG would be then, let's say, the commodity or the molecule which sets also the price on TTF in a majority of ours. So I'm not perfectly sure what the problem it would solve if you would lean towards TTF. And I think the proposal here is not to look at gas too much, so let the gas market be what it is, but kind of redistribute the income from producer to the consumer, so to cap the producer surplus, and then kind of increase or decrease the price for the consumer.
So just to add to that, I think the big danger, so there's discussions around capping the price for imports, and not clear whether it's just going to be Russian gas or LNG in general. The reality is actually, for the moment, the Russian gas is only a really small amount now of the gas, so of the gas supply in Europe. So it's making around 5-ish% at this point. So if you adjust price or put a cap on the Russian imports, is actually not going to really affect the price. The prices will stay high. But if you put a cap additionally on the imports for LNG, the issue is that the gas will go to Asia, where the prices are much more beneficial, and we are competing directly with Asia for the gas demand. So effectively, this will lead to a much lower supply, which is obviously something that you don't want to have at this point.
Yep. Jerome and Anna, I think I'll put this question to you too. I mean, isn't it, in a sense, kind of ironic that you have the Commission has been trying to get away from or disencourage or effectively slam down on regulated prices and long-term contracts, but yet now that is what is on the table. Jerome, if I can start with you.
Yes, ironic could be the word.
That's maybe a kind way of saying. You could put it a bit stronger potentially.
Yes, I mean, it's like I understand the need to act. There's a clear political will. There's also the reality of plenty of domestic consumers who will not be in a position to pay their bills this winter. Industry that may be in a difficult position as well. So we need to do something. Now, plenty of ideas floating around. We don't always know where they come from. And when Anna earlier, you talked about how Acer is not necessarily involved as energy specialists. I think it's the case for plenty of lower parts of the Commission, actually. The specialists are not in charge anymore. So that's where we get into a realm where suddenly we're deconstructing very fast what we've started building over the years. So yes, for instance, in draft emergency regulation, there are parts on the regulated retail tariffs, a re-extension of that, massive, while the Commission was on a track to get them as restricted as possible earlier. Questions around long-term contracts, new ideas like changing the benchmark, for instance, of gas contracts without necessarily thinking that, well, this is in contracts that cannot be renegotiated or that would need to be negotiated with two people around the table. It does, things don't get changed like this. So it's ironic. How does it play out and how does it work? I really wonder how we want to change part of the system, but still expect investors to put in private money into that sector. So that's really what decision makers, hopefully when the heat of this crisis will be over, hoping it will be over at some point, that's what they will need to start thinking about. In the meantime, we're just dealing with the added risk this creates on markets.
Anna, what's your view? It's kind of the question.
Well, I mean, it's in situations of emergency, which is when the decisions need to be taken right. Otherwise, they're irrelevant. What politicians do on a day-to-day basis in non-emergency it goes by unnoticed because it has no impact on the market. So it's actually the reverse. I think we have to hold them to account in the sense that they can't do what they're proposing to do. First of all, why single out the energy companies as making ridiculous profits? I want a cheap Burberry bag or whatever it is, so why can't I now have a capped price on, a luxury handbag. I mean, who says what the marginal, you know, why don't they set prices for everything then? So I think the key thing that we need to understand is that they're actually, in a way, desensitizing us to interference into the market. And I believe that this is the beginning of the interference into the market for the reasons that I explained. Because I don't think whatever action they take now is going to solve the problem of where we're going to be in March. And in March, they're going to have to do a far more dramatic interference into the market. I think even before that. I have no idea what they're going to come up with, but I believe that that's where we're going to be. And so, and this is why I find it very difficult when we are in Brussels. We're not taking them on, and we're not saying these proposals on price caps, all of these things, they don't work. What we do is we engage with them, and we give credentials, credibility to their proposal, because we actually spend hours and hours explaining how you need to fix this, and if the cap has to exclude this, and fundamentally, it's the fundamentals of it that is the wrong approach. So I think this is my concern. And I forgot to mention, I mean, the joint purchasing of gas and everything else is not off the table. It is very much on the table. And so then what will be the role of an energy company? What is it then? They don't buy the gas, they don't sell the gas, they don't set the price, they don't even run the company because they're not meant to pursue cases that they think they should. What's left? And then I don't think that's the end of it. I think that's the beginning of what might be, of what they want to, you know, how they see of what they will need to do. If all of, and basically I'm rambling, but I think the main thing is if they start, if we go on this path of now doing the capping and doing all the rest, because it's not going to work, the next interventions will be even more dramatic. And that's, I think, where the concern is. And then ultimately, what they'll set the price for glass and water. I don't understand exactly what the objective is. But, you know, Ursula made the announcement on the decoupling of gas. From electricity. I was there. It was in Bled Strategic Forum. She was walking down the stairs. She made that announcement. Completely left unaware, the DG Energy, of that decision. That's where we're at.
We'll come back to that, I think. But any questions from the floor? Yeah. Yes, over here.
Yes, Graham Wheel, 2 quick observations, then a question. What we're seeing is a classic battle between economics and politics. The mantra of the European Union since 1985 was get the internal market to work. But as soon as we come to a crisis, it's politics which dominates, and now we run the risk that politics for the foreseeable future is going to damage the economics. That's point 1. Point 2, what we're missing in the situation are the energy prices reaching the end consumer and the end consumer really being aware of what they are and reacting to them. Energy has become a luxury good, and if householders were properly confronted with the day-by-day, almost hour-by-hour energy prices, if they're rational people, they'd react differently. Those were the comments. The question is, if you were in Ursula von der Leyen's shoes, what would you advise her to do?
Thank you, Graham. Is that directed at all the panelists or anyone who wants to take it? Thank you. So, Jerome, we can start with you.
Great. The shoes would be both too big and too small for my size 45, but too big because Ms. van der Leyen has accomplished a lot. I see your point, politics versus economics. Fundamentally, and this is not a surprise, as politics comes back very strongly. Fundamentally, for me, this is about energy because we have a scarcity of energy supply. What they're trying to do now is solve a social policy problem. It's about redistributing money to people who cannot afford energy. And because energy has this specific place in our world where It's a little bit different from a Burberry handbag. It's something that people use on a daily basis and have been used to doing that at a cheap price. But yeah, for me, it's a social policy question. So it should be addressed with social policy means, not reinventing an internal market for energy that plays with different rules than anything else. So yeah, I would push member states to address this, like with social policy means, rather than tear the whole house down. That would be my 2 cents.
So Anna, turn to you. If you'd been Ursula at the BLED conference and the forum, and you'd been in her shoes, what would you have said?
Well, I wouldn't have said anything on the spot. I would ask my experts for an opinion. I think there's 2 things. I mean, the UK is doing things slightly differently. So it's addressing the end consumer, both industry and ordinary people, and it's going to pay for that through its budget. I mean, we might go completely bankrupt, but admittedly, the idea of actually intervening in the way of taxing companies and setting caps in that respect is not something that the UK government is prepared to do, and I think that is an indication of the difference in approach, and I think that would be something that needs to be considered. Ultimately, the situation with the lack of gas can only be addressed in one way, and that will, I'm sure that I'll be saying something that will be completely sacrilegious, but there'll have to be a peace settlement, and whatever it is going to take, and that's what's going to have to happen. And the question is going to be, at what price will it be for us? But I think that's the reality that nobody, certainly in Brussels, is not willing to take. And then just on the point of the Burberry, I knew that you would take that. So I'll give you another example. Why are the pharmaceuticals not taxed? So that's why I went for the Burberry, simply because the reality is that everybody, that's what the market is. It is about making money. If you don't want that system, then you change the whole system and you call it communism or whatever else you want to call it. I grew up in it, so I can understand it, but then you have to change the name.
Yep. Tekla, what would you do in von der Leyen's shoes?
Yeah, it's a super difficult situation in which all of the politicians find themselves. I'm really happy not to be one in the last couple of months. What I think was really missing is something that we're not talking about enough, and it's moving away from my day-to-day job. I would have done a massive marketing campaign to reduce the demand of the households. I think there is still a massive lack of actual understanding that the households, each and every household, can contribute to improving the situation by, reducing heating and so on. So, I mean, there have been a bit of a laughable examples around using a Waschlappen instead of, to say in English, instead of kind of taking long showers. But effectively, this is really something that the kind of the non-energy knowledgeable people and the broader wider public doesn't yet understand. And the industry has managed to reduce the gas demand by 20%, but we have seen nearly no effect from the consumers, and it is very much coming back to what Graham said, is that there is no visibility on the price increase, right? So in the usage of cars, for instance, is directly changing when the prices in the petrol station show up higher, and then everyone is waiting a day until the petrol prices look closer, and there's no visibility really on the increase in the price of electricity, the increase in gas prices. So that's kind of the big campaign would have been really my wish, really big advertising, what's it called, cardboards, and coming to the current situation. There's still lots of open discussions or open points to be clarified in the next couple of days and weeks on how exactly the measures will be implemented. I mean, we're talking a lot about the futures and the forward markets, but there's other real issues to be solved. For instance, how does the intraday market work with a price cap? How can we incentivize market participants to still participate in those markets? If they also get a cap, there's no incentive to participate. So there's lots of still open questions, really fundamental questions. It's really an open heart surgery. These kind of really big interventions in the market would usually take months and months to really design and make sure, model everything and make sure everything is set. So we are implementing something that has never been tested. So the implications will have to be seen.
As we've said several times today, we're in an unprecedented situation. It's uncharted territory. Any other questions from the floor here? I think I'd like to, I know we're running out of time, so I'd like to finish off, try and extract some kind of ray of sunshine, some kind of optimism from you. There's been a lot of doom and gloom today, but I think if I can start with you, Simon, then we can move along. What's the best case scenario for this winter?
Yeah. So let me
Probably obvious, maybe a very mild winter and no snow and lots of rain in the Nordics.
So I would love to think about, in some years or some months hopefully, about this phase as a phase which really transformed the thinking around energy transition. So coming back to the point from Graham around the battle between politics and economics, I would love to think that we soften the social impacts on a society and industry. However, the incentive to accelerate energy transition will be massively increasing, and I mean that on the industrial sector through efficiency measures, on a household sector through rooftop solar, through heating, etc., etc. So I would love to think it's similar to COVID, where we made kind of a giant step in terms of digitalization in kind of 1 or 2 years, which would have normally taken a decade or so. That would be, for me, a fantastic outcome.
Thanks, Sam. Tekla, if I can just move along, from.
Obviously, it's quite difficult to talk positive in a very, very grim times. I think on the positive sides, the gas storages are filled up to a level like they've never been before. There is energy imports coming in, so at least from Aurora's side, we're fairly confident that we can go through the winter. Of course, if kind of the massive winter will come in, it will get tight also. But at least we feel more comfortable and confident that we'll get through the winter than we probably were a couple of months ago. And then the major hope, obviously, is to get the FSRUs connected as fast as we can. There's one that is nearly finalized, so the floating energy terminals, one coming up next year. I think this will already a little bit improve the situation, but that could at least contribute. So I'm hopeful about these two aspects, especially.
Excellent. Jerome?
Yeah, being hopeful for the winter, it's really like making a guess on weather. So I won't be able to do that, and weather forecast specialists, I'm sure there's some in the room, have a better idea than I do. I think it's also, right now is also the opportunity to think about the future. How do we get to a market design and generally a situation of the energy sector where we don't get the same kind of frenzy when the next crisis hits. So we've seen this with COVID. We were not prepared. It got crazy. We went into all kind of direction possible. Every member state or country in the world applying different rules. We're kind of experiencing that again with this crisis in the energy sector. So, like, how do we not do that again next time? So in terms of crisis management, some lessons, in terms of market design, because we have a market that is delivering what it was built to do, doesn't mean that we cannot think about how to make it even better. Like renovation to houses exists, and they don't just like stay like this forever. Thinking about forward market, how we extend the horizon, like a forward market. And for that, we also need consumers to be on the other side of that. We don't have a 10-year forward curves just because we have 1 or 2 year consumer contracts. So like things like this, all the way down to how do we make sure we integrate all the flexibilities in the system, link this system to other parts of the energy sector, hydrogen, gas, etc., instead of decoupling them, like trying to have a holistic way of seeing things so that we tap on all the flexibilities that because there is a lot of flexibility in our system. So ideas for reform and for crisis management, that's what this current crisis can bring to us.
Thank you. And finally, Anna?
Well, I'm not pessimistic, because if I was, I wouldn't be going to Brussels every week. So my view is actually a different one. And I think the point is that the voices need to be stronger, that challenge what is sort of almost like a dogma that is being repeated. And the more it's repeated, then the rest just are silenced. So I think that's what I'm hoping will happen between now and hopefully October, November, because my view is that by December it'll be quite too late to change things. And I'm certainly not for centralizing anything, exact opposite. I think both COVID and from a EU point of view and this crisis have showed the exact opposite, that it's the centralization that is causing the ability of people like Ursula to make statements on behalf of everyone. And it's actually letting the market play that is what is needed. So I think more voices is what we need. And for me, the lesson is the more voices. So I'm calling for that. That's my optimism.
Excellent. Well, Anna, Jerome, Tekla, and Simon, thank you very much for this panel discussion. Very stimulating. Some very good points raised. Thank you very much.
Thank you.
And here's a little something from us, Simon. Thank you.
Well, thank you.
Tekla.
Thank you again.
Please go.
Thanks, Jerome.
Just some final words from me. Maybe Bled, you could put the map on presentation with that slide on. But in the meantime, I wanted to end on a slight kind of optimistic side. I mean, it's not all doom and gloom, although it does seem that way at the moment. I think there are some rays of light, but they are few and far between. The coming months will be critical. Now, so hope and luck, as we heard in the previous panel, is certainly not a strategy, but I think we're very much in the hands of Madam Fate, Madam Luck, in terms of the winter and what that brings. So, failing that, I think, as Tekla was saying, I think it's on us as energy consumers and the wider energy consumers to reduce the thermostats and put on, jumpers to make sure that we reduce as much as possible our energy as possible. Now, just to reiterate, these issues will all be covered in and are covered regularly in Montel News, so please continue to read Montel News. I have done, and I will bring up a lot of these topics again in the Montel Weekly podcast, where a lot of the speakers today are regular guests. We bring that up in a more in-depth conversation for sort of 30 minutes. But I think finally, I'd just like to say a big thank you to you. Great to have you all back at the German Energy Day. We are back in business. And I'd like to say thank you, especially big thanks to the Montel technical support and Maria and Bled and the camera work, Ochal and Cordy, done a fantastic job today. So thank you very much.